Afternoon, everyone. Thanks for joining today's session. We will kickstart in the next 1 minute. So we'll allow everyone to join. Hi, good afternoon, everyone, and welcome to the afternoon session of the JC3 Finance for Change Flagship Conference, hosted by Bank Negara, Malaysia, and Securities Commission, Malaysia. This event is supported by the UK government's ASEAN Low Carbon Energy Prosperity Programme in partnership with Ernst & Young. This conference would not be possible without the support and hard work from CIMB, SME Bank, and Zurich, and without the help from our knowledge partners, Climate Governance Malaysia, WWF, FIDE, Forum, FIDE, SwissRe, Fair Finance Asia, AFI, and ITFIM. I'm Arina Kok, and I will be your MC for today. I lead the Climate Change and Sustainability Services for EY here in Malaysia. Some of you may not have joined the morning session, so please allow me to share a bit about the JC3, Joint Committee of Task Force for Climate Change. And this JC3 was formed in 2019, co-chaired by Bank Negara and Securities Commission Malaysia, with members comprising senior officials from Bursa Malaysia and 19 industry players. The JC3 is set up to pursue collaborative actions for building climate resilience within the Malaysia financial sector. So before we kick off, let me make some housekeeping announcements. So the first part is, please note that this conference will be recorded with replays made available on the ITFIM website. Secondly, microphones for audience are disabled, but please submit your questions via the chat function. Attendees are able to change the layout and resize the panels on screen. We will be conducting polls throughout the sessions, so please stay engaged and participate as much as possible. If you face any technical difficulties, please drop a message in the WebEx chat to the host. We will have someone that will attend to your questions. For the smoothest conference experience, we would highly recommend tuning in with a desktop or laptop and ensuring there are minimal applications running in the background. I also like to invite you to keep engagement going by tagging us on the social media using the hashtag Finance for Change. We have an exciting lineup for you over the next couple of days. You'll see the agenda on your screen right now. So this morning, you may have heard the messages from the naturalist Sir David Attenborough, Governor of Bank Negara Malaysia, Datuk Nur Shamsia, and the UK Regional COP26 Ambassador for Asia Pacific, Mr. Ken O'Flaherty. Then we had 3 panel sessions covering why and how to begin your sustainability journey. So this afternoon, without further ado, we have split ourselves into your selected sessions to get into the deeper discussions about specific segments for the finance industry. You are now in the segment focused on topics relevant to the insurance sector. And we have industry experts from Zurich General Insurance, SwissRe, Malaysia Takaful Association, and Etiqa Insurance to share knowledge on sustainability in context of insurance and Takaful sector. Keep sharing what you learn on social media with the hashtag Finance for Change. So for our first session for the afternoon, we will be sharing a presentation entitled Examining the Past and Visualizing the Future, delivered by myself, my colleagues from EY Singapore, Russell, who is also in the Green Finance Lead for the UK Government LSAP, ASEAN Low Carbon Energy Programme. We also have Suzanne Biegel, founder of Catalyst at Large and an expert in gender smart investing, joining us at the end to provide an insight on how gender relates to climate. This presentation sets context for this focus session by talking about general sustainability risks and impact to the financial services sector, how to actually go about adapting business model to sustainability, what are the sustainability finance opportunities, and how to align setting the 2030 sustainability commitments, among the other things. So now, since this is a common session to be developed, all 5 parallel sessions being run right now, we had to pre-record it to ensure everyone has the same content and experience at the start of this session. So I will move on to the next and let the show begin.
Hi, good afternoon, everybody, and welcome to this afternoon's session called Examining the Past, Visualising the Future. My name is Russell Marsh, and alongside my colleagues Arina and Suzanne, I will be presenting for you this afternoon. So firstly, the 3 speakers you hear from this afternoon are myself, Russell Marsh, and I'm a director at EY based in Singapore. My colleague Arina, who's a director at Ernst & Young in Malaysia, and Suzanne Biegel, who's a founder from Catalyst at Large and a co-founder of Gender Smart Investing. So today we'll be covering an overview of the general sustainability risks and what that means in terms of impact on the financial services sector, how business models need to adapt to reflect that sustainability, in particular looking at opportunities for sustainable finance, aligning sustainable finance to national 2030 commitments, looking at how you integrate governance and management in terms of looking at sustainability, looking at enablers of sustainability change agents, and then finally, gender and climate investment. So firstly, and I'm going to lead this part of the session this afternoon, just looking at what are sustainability risks and how do they impact on the financial services sector. So firstly, what we're seeing is a range of activities that are creating pressure on businesses to increase their focus on sustainability and ESG. And I think it's pretty clear now that sustainability and ESG is no longer an option, but it's a necessity if businesses want to stay relevant. And on this slide, we just outlined a number of those pressures that are changing and coming to businesses, and particularly the financial sector, why they need to start really taking into account ESG and sustainability. And that's both in terms of the first one on that slide, in terms of the science, in terms of the changing, the warming world, so in particular in relation to climate change. That's leading to increasing prominence and focus on the global agreements for climate change and getting countries to take on increasingly tighter targets for emission reduction. You've then got national governments increasing their regulations around how financial institutions and corporates more broadly should take into account a focus on climate change in particular, but broader ESG. You've now got an increasing demand for non-financial information from investors, all looking to understand the ESG impacts of their investments and asking those companies that they invest in to provide much more non-financial information and much more ESG investment and data as part of their decision-making processes. And we're seeing consumer behaviour changing. So consumers are starting to demand more products that provide a more positive impact on the environment and more sustainable products. And so we're demanding that through their purchasing that they're starting to look at these, adapting to and buying these kind of products. So looking particularly right now, we're obviously in the middle of and hopefully coming out of the COVID-19 pandemic, but the onset of the pandemic and this increased focus on climate change has really highlighted the importance of ESG in investment decisions. And looking at the stats on this slide, what it's showing is how investors are viewing a number of these ESG issues. It's clear that majority of investors are really starting now to look at a whole range of ESG issues, whether that's climate risk and natural resources, whether it's gender diversity, whether it's evaluating companies' non-financial performance. So there's a range of different factors that investors are now looking at when they start looking at their operations. And you can see that that has grown over the last couple of years in terms of that slide on the left, or the left of that slide, showing the percentage of respondents in the survey, how they looked at things like environmental, social and governance risk, and that's dramatically increased from 2018 until 2020. And taking that a little bit further, we've now seen that the top identified global risks have shifted very much now towards focused on environmental, social, and ahead of economic factors. And this is a study that was done by the World Economic Forum that's looking at this global risk report. And so if you look at the difference between the top 5 risks on the left and the top 5 risks on the right, it just shows how now extreme weather, climate change, natural disasters are much higher risk than some of the economic risks that were at the top of the list in 2010. So that's just a clear indication of how global risks are being looked at and how climate change in particular is now seen as a significant risk. And looking at that again in a different way, this is another similar graph from that report from the World Economic Forum in terms of global risks. They show that the climate action failure is identified as the risk that have the greatest impact and is the second most likely long-term risk that's been identified. And what we've seen, in terms of the global pandemic, we've seen what happens if you ignore the long-term risks of things such as pandemics. And obviously the goal now with the pandemic is to reduce harm while waiting for a vaccine. However, there is no vaccine for climate change. So we need to take action on climate change very differently to how we're dealing with the pandemic. And the other thing to recognise, obviously, is economic activity has bounced back after the financial crisis, and that's starting to see emissions increasing. And so we've got to look at how we can grow the economies, but as we emerge from the pandemic, but without having that similar impact on global climate change emissions. Also seeing climate change impacts are now emerging much more quickly than anticipated, and on the left just highlights a number of the measures and impacts of climate change, and it's showing that we're starting to see all of those increasing much faster than had previously been seen, whether that's ocean heating, sea levels rising, or the Greenland ice cap melting. And that's leading to things like greater income inequality, higher food insecurity, and increased urbanisation as people have to move away from areas that are going to be subject to coastal flooding in particular. So then looking at, what does that mean? So how does climate change, how do those natural impacts of climate change end up becoming a source of economic and financial risk? And what this slide does is look to just summarise that at a reasonably high level. And what we talk about is two things. We talk about physical risk and we talk about transition risk. So the physical risk is the risk by an actual natural disaster event, so like an extreme weather event, what that actually the impact that can have on the financial sector, again in terms of having to build back that infrastructure that's destroyed. That's a definite risk and a physical risk on the financial sector. And then you've got transition risk, and this is the risk to corporates about having stranded assets or this move towards a lower carbon economy. And so an increase in policy and regulation from governments, emerging technologies that take over because they're low carbon taken up by the market, and general market sentiment. Again, we talked earlier about how you're starting to see a number of drivers on companies to move towards incorporating ESG considerations within their operations. And if companies don't respond to that, so they can end up, say, having a big financial impact as the products they provide are no longer wanted by the market, or to say the products they produce are impacted by changes in policy and regulation. If you're thinking particularly about the energy sector, obviously as governments increase their focus on reducing carbon emissions from the energy sector, if you've got a high carbon intensive energy sector, that can be a big risk in terms of the speed at which some countries are taking that transition to a lower carbon energy sector. And looking at that a slightly different way, this takes us a little bit further. Is okay, how do we see those climate change effects come through in terms of the economy and financial stability? And looks at, say, both again from the physical risk drivers and the transition risk drivers, where you see, as a result of physical risk, you see this business disruption. You might see capital scrapping. And that will lead to potentially lower property values, lower household wealth, and that can have a link through into the financial system in terms of financial market losses, credit market losses, etc. And then similarly on the transition risk, where you're seeing changes in climate policy, change in technology, change in consumer preferences. You could potentially have stranded assets in terms of fossil fuel generation technologies, some real estate infrastructure, etc. And that can lead to corporate asset devaluation, low corporate profitability, etc. And then have lead to financial market losses. And then there's obviously feedback loops within that in terms of the financial contagion through market losses and credit tightening, feeding back to the economy. So what you've seen there is at a relatively high level how, in particular, climate change can have a direct impact on the financial system and a direct impact on the economy, and therefore, how businesses broadly and the financial sector particularly start thinking about how can it adapt its business models to respond to that challenge, and in particular also thinking about the opportunities. So what this does is look at, again, how does sustainable finance, what does sustainable finance mean for the full business model of an institution? And what this slide looks to do is try and look at, across the whole of the operations of a business, what's their role and what's the impact of this continued focus on ESG and sustainability and sustainable finance on that company. And that's everything from so you've got the business implications and challenges on the left. You've got, in terms of shareholders, you've got change shareholder goals. You're starting to see increasing shareholder activism, where you've got shareholders who are looking to really change the internal process of the company and get it to take on higher targets, particularly for climate change emissions, through using its ability as a shareholder. You're starting to see new investment products coming out into the market. You've got new terminology, new regulatory requirements for you to understand and how you can embed those within your risk management system. You're going to have new and change risks. So the risks that you're facing now and the risks you might face under some of the scenarios for climate change could be quite different. So you need to understand how those risks are changed and how that fits within the company. You may start to see change policyholder behaviour, changed employee behaviour. Again, employees looking to see their company do more in some of these areas. So how do you respond to how employees are starting to view these issues? Your business partner behaviour, again, working with a lot of businesses, what are they doing? How are they changing their behaviour? How are they responding to these demands? But I think also looking at product innovation is it's not all risk. It's also looking at these new market opportunities. Particularly look around in terms of the energy transition, moving towards a lower carbon economy. The amount of investment, the amount of new technology we're going to need to meet some of those targets is huge, and that's where there's real opportunity for companies to start looking at where they are now and where the opportunities are in the future, and how they can start to move towards embracing and taking the benefit of those new opportunities. And this looks at this a slightly different way in terms of looking across different parts of how this transition, these strategies for sustainability works across different parts of the organisation. So you've got products. So we know, again, I talked about consumers continuing to demand more ethical and sustainable practices and products, and again, being able to have products that meet that need. Within internal operations, again, how can you make sure that your internal operations are becoming more inclusive and environmentally friendly, and having those internal policies that help drive those activities? So, impact investing, where FIs are now looking to invest in projects, companies or organisations that have some positive social and or environmental impact. So looking explicitly to seek out those opportunities to only invest in technologies and companies that provide this specific environmental impact, whether that's renewable energy, social housing, as some examples. Looking at distribution, again, how can you adopt sustainable ways of distributing services? So there's this US bank with its in-app voice assistant, so it provides better accessibility for banking services. And again, just to see how the distribution of these services is changing to meet the needs of retail customers in particular. Collaboration, seeing particularly in the sustainability space, we're starting to see a number of external partnerships between financial institutions to help increase and offer this wide range of integrated ESG solutions. The example put up here is about BNP Paribas collaborating with Greenly to offer some carbon tracking to its consumers through their banking app. And that's just an example of how collaborating externally can help drive a new product and innovation that this particular institution wanted to deliver. And then policy, again, how you're integrating and incorporating ESG into operations. And a number of banks and financial institutions and others are signing up to various frameworks and strategies to help align their operations alongside related ESG-related causes. I think it's fair to say now that financial institutions need to do more to overcome the barriers and reap the benefits that ESG provides. And this slide looks at some of those. So this integration of ESG into risk management services. So really having ESG criteria integrated as part of their already risk management frameworks to help move their capital flows towards more sustainable investments. Looking at addressing gender diversity just beyond equitable workplace ethics. So looking at how you extend some of these frameworks around gender diversity down the supply chain and to customers as well. Common taxonomy, this is often the most difficult one in terms of, again, how do you define what we talk about when we mean sustainable? And sustainable practices and sustainability means many things to many different people. So having an agreement around what is a common taxonomy, what do we mean when we talk about sustainability is really helpful, and also useful to see that there's work going on within Malaysia to help try and develop some sense of what that definition looks like within the Malaysian market. Again, common standards for ESG disclosures. There's a range of different standards out there, and again, having this convergence and global guidance on sustainability standards will make it easier both for the industry to adopt those standards, but also then for the external stakeholders to be able to follow and understand what it is that companies are doing. And then elimination of greenwashing, and this comes up quite a lot in terms of being really clear that what you're doing and what you're promising to you are doing, and the consumers and others can have real confidence in that again the ESG claims you're making are actually backed up by what you're doing. And this is just one example, and I won't bear on in this too much, as again you can look at the slides in your own time. This is just an example of where Barclays, a bank, is focusing on products, distribution, impact investment, and policy for its sustainable growth. So how it's looking across all of those issues, both, and a couple of examples we put on the slide in terms of looking at green home mortgages, looking at sustainable investing solutions. It's looked at financial inclusion for the disabled. It's looked at how it works with some financially vulnerable consumers, and it's had an impact eligibility framework, providing clear social, environmental, and inclusion criteria to track and categorise financing volumes, so including labelling green and social transactions. Again, that's just an example of how this particular financial institution is looking across all of those different criteria to look at how it can become a more sustainable company and has more sustainable growth. So I'm now going to hand over to my colleague Arina to take us through the next few sections of this afternoon's presentation. So thank you very much for the moment.
Thank you, Russell. And I'm going to kickstart with the next part. What we're going to do for this next session is really to discuss about how, essentially the finance for change can actually drive or rally, direction from all sources, as well as how does it align not just from a national 2030 commitments, how do organizations like financial institutions can drive this, and down to the granular detail of what each enablers or business unit can do. Now, looking at the next slide, when we look at what Malaysia has been focusing on, we do have a commitment to achieve the 2030 Agenda for Sustainable Development that addresses the key mega trends. So in 2021, the United Nations Sustainable Development Cooperation Framework 2021 to 2025, the UN SDCF, constitutes how the UN development system could support Malaysia's strong commitment to achieve the agenda. And it's really very much focused on the aspiration for Malaysia to become a high-income, inclusive, environmentally sustainable, and advanced democratic nation. And what this framework helps is to support, a effectively collective system support for the country to address where are the bottlenecks, the trade-offs, the synergies towards the journey, and essentially to also provide the United Nations system support to strengthen the whole of nation approach to achieving these SDGs. And when we look at the diagram here, these are the 6 focus areas, as we can see, and how it's aligned to the 17 SDGs. Now, I just want to highlight that these are the key material issues where we have to actually have a targeted fit for purpose solutions that actually can drive multiple benefits on these areas. So when we look at the population growth and demographic change, there will be certain strategic areas that can also be addressed by the likes of digitalization, how this can actually drive certain microfinance, whether the digital banking can actually drive some solutions towards the new world order, and what are the pressure on the ecosystem in terms of the health requirements, as well as the food security discussions. What are the societal changes and changing face of the customer? When we look at infrastructures are being reconstructed and re-looked at to consider the drive of EV infrastructure, or the likes of upgrading in terms of not just on renewable energy, but consideration of storage and CCUS. These are the mega projects of technological innovation that will come into play. Of course, the key question now is how does finance as well as the larger ecosystem bring this change? So looking at where the funding gaps are essentially focused on, when we look at the statistics that has been put out in place, so according to the UN conference on the trade and development World Investment Report, between $3.3 to 4.5 trillion needs to be mobilized annually to achieve the 2030 Agenda for Sustainable Development. Now, this essentially highlights the funding gap for investment, and this is where the opportunities lies in for not just the public, but also the private sector, especially for developing countries, which is estimated at $2.5 trillion. Now, the graph essentially outlines the 2.5 million, but what we want to highlight is when we look at the graph chart on the right-hand side, you can essentially see where the key gaps are in the power sector, focusing on power sector, and the climate change mitigation, transport, telecommunications, and ecosystem or biodiversity. So this is where the focus areas and the growth drivers are going to be angled by most investors as well as companies on this journey. Now, when we look at examples of how financial products and services can essentially drive or address the sustainable development goals, for all these 16 goals, including the 17 on partnerships, the focus areas essentially, when you look at no poverty, it's essentially driving finance through impact investing. I mentioned about microfinance for smallholders farmers can actually support the goals towards zero hunger. And when we look at healthcare investments, it does essentially drive good health and well-being. And this is where there are digitalization in terms of telemedicine, having the digitalization that will actually help the outreach for those underserved. And when we look at philanthropic donations to schools, it doesn't stop there, but it could also be enabled by digital education. And when we look at microfinance and lending to women and female entrepreneurs, that's where it would drive gender equality and keeping women and the underserved to actually have continuous career to support their family income. And then when we look at clean water and sanitation, this is where socially responsible funds can invest in water and sanitation, and this can also drive access to businesses as well for the underserved. And for affordable and clean energy, I think we mentioned about renewable energy investments and new technologies. For decent work and economic growth, there are general investments in the real economy. For innovation and infrastructure, it would be essentially relooking at how project finance or commercial can lend and integrate ESG criteria in their lending decisions, which we will see a huge significant ramp up in this year for the financial sector. And in terms of reducing inequalities, it's essentially to drive fair payments, not just for financial sector employees, but also to drive it, in terms of the investees or the customers that you're lending to. How do you then advocate for those policies? For sustainable cities and communities, it's also considering, how do you look at the mortgage lending to provide more climate resilience enablers to actually discuss on how climate risks are being mitigated and adaptation considerations. For responsible consumption and production is essentially driving the socially responsible investing. Climate action will cover in more detail, including financial ecological services that covers life below water and land, and essentially, lending to public institutions to consider for, driving peace, justice, and strong institutions. So when we look at, how sustainable finance have become urgent to achieve the low carbon economy, essentially is also looking at, how it is already impacting, if not every aspect of the economy. So I mentioned about, the connectivity, not just on agriculture, residential, human health, labor productivity, but what essentially would be key is what are the societal issues or environmental issues that has to be tackled. So these are the key questions to ask, as part of the organization or as part of society is, should leadership on environment or social issues be an essential part of the purpose of the organization? What are your current engagement on environmental and social issues, whether it's authentic to your culture, brand, and your products? How do you play an active supporting role in transitioning to net zero? Every organization has its roles and responsibility, but how do you integrate this within the organization in the day-to-day operation? How does sustainability intersect or influence the business strategy and operating models? And how do you determine this climate change will impact your business model? Now, when we look at the type of sustainability commitments that can actually drive direction in the organization, these are the various areas that actually can be contributed by financial institutions. I won't go through it all because I mentioned it earlier, but in terms of the decarbonization commitment, I think there has been a lot of questions in terms of what does each commitment looks like. So we thought, it would be timely to actually just highlight here that there are various iterations of what a decarbonization commitment looks like. Here we see carbon neutral, carbon negative, net zero, and science-based targets. Having that different equation or iteration, whether does it cover emissions, is it being offset by removals, or it can be offset with science-based targets. So these are the 4 different iterations, and organizations need to then define which one works for them in order for them to consider what commitments are most reflective of their vision, mission, and their direction in the short, medium, and long-term future. So when we move on to the next part, after looking at the macro scenario, now let's get on to the institutionalizing, how do we then bring this into the organization, going to the granular detail. So when we look at the integrated governance and management approach towards sustainability, I would like to just keep the key focus in the next slide. Okay. So when we look at the governing body or audit committee and consideration internally and externally, when we look at the organization, typically for financial institutions, there is the essential 3 lines of defense. You have the management controls and internal control measures as the first line of defense, where they carry out the sustainability risk assessment when onboarding clients during pandemic review or existing clients. Now the idea is also then apply that for environmental areas and to also engage with clients to understand their level and business plans and to consider the uncertainties. When you look at the second line of defense, essentially it's also the second part of the organization that looks at the financial controller, security, risk management, quality, inspection, compliance. How did the second line of defense actually set up their own central risk frameworks, deliver the training, develop scenarios, and undertake stress testings. And these are the part where it goes to the third line of defense, where you have the internal audit as well to review the control design and execution. What's to highlight here is this does not stop there. There is also the external audit consideration and the regulators who will also evaluate from the external viewpoint of things. Now, when we look at how this will actually change the approach, essentially learning from what the pandemic has impacted in terms of the governance, it has reinforced the importance of the long-term value approach to actually build resilience. And in terms of the drivers of the approach are pretty much the key stakeholders and the business leaders, where there are increased expectations, where organizations need to play a more proactive role in tackling the societal issues, including climate change, and inequality. And you also see business leaders who now start to, have that conversation, how the CEOs and board are connecting and driving the sustainability performance strategy and targets. What's their role in driving, having a more purpose focus, to address the various key stakeholders' needs. So this essentially, outlines a research that was done by EY that actually highlights, to what extent the board has put in place the following practices. We can see that there is a growing, based on, long-term value maturity, there is a growing need to actually evaluate, what the strategies are in terms of improving the long-term value. And where we see the laggards are is essentially also considering, how do you then incentivize, the remuneration schemes to ensure that this long-term value are being driven internally and they're being compensated as well, aligned to actually ensure the longevity of the organization. So when we look at the framework, how to integrate the approach to address sustainability, typically it cuts across two aspects. One is on the strategy, one is on the compliance. When we look at the strategy governance, it is also to look at how do you drive that proactive, taking certain risks, looking into ventures, where the sustainable finance, where the risk and strategy and opportunities lies in, what are the transformative that the organization need to look for. When we look at the compliance side of things, essentially you have the board risk committee that actually looks at where the risks are, as well in terms of the stress testing, the financial capability, and where the portfolio would look like. So these are the two hats that typically would be be institutionalized within an organization. There is a part where the more proactive pursuit and risk-taking side of the business, and there is the other part that is a more risk management kind of approach. But essentially, this falls within the organization, essentially, and how this is being driven is to really have that two enablers within an organization rather than just have one set up. So the eventual integration to the business functions as well as rules needs to be clearly outlined to actually drive an effective integration. So when we look at breaking down even further what the enablers or sustainability change agents are, this is where we look into the setup organizational function. Where we look at, where every facet of the organizational and operational structure is affected by the ESG. And we can see that, from the high level to the board and supervisory board level, you will then need to consider now in terms of the, how the board drives sustainability strategy, performance and targets. You will also consider how the board risk committee will actually evaluate risk. But you will also consider now for remuneration committee, how do they connect the performance of the board and senior management as well. So this is where the high level set infrastructure would be before it's trickled down to the next core process as well as the supporting process. The core process, essentially when we look at product management, it would be looking at the various sustainable investment. How do you consider the green and brown assets and greenwashing? Where you talk about marketing, there's also market position. Where do you communicate your performance? How do you manage the engagement with your internal and external stakeholders and the regulators as well? And in terms of the sales, is essentially to drive, what are the financial advice that you're going to give to your investees, what are, as well as to your customers, coming up with various products that actually fit their needs, and considering whether is there opportunities to drive new technologies as well in terms of sales. And in terms of processing and handling, there is, the discussion of the conflict of interest, taxonomy, what's the use of funds, and when you come to customer service, it's essentially how do you handle the grievance mechanisms, the complaints and the governance structure. So when we look at the support processes, these are essentially where the other parts of the functions of the organizations is the legs, the arms, the heart that actually need to also rally together. This is where you see in terms of the laws, the regulatory affairs, the finance, the compensation incentives needs to now come together to actually see how they can actually consider the advancement or the components of ESG into how they actually operate, incentivize, provide legal advisors, handle the business operations, whether, when you look at asset management, how effective are the assets and how resilient is it, towards flood, climate risk. So these are things that needs to be considered. I won't move into more detail when we talk about these aspects. When you look at integrating sustainability into procurement, what we see now is essentially the drive on improving global human rights situation, and as well as fostering the UN SDGs. So it's also considering, what are the greater responsibility to contribute to climate protection, material efficiency, what are the social standards and good governance that needs to be driven in the supply chain management, as well as, when it comes to risk mitigation, how do you ensure the security of your supply chain? How do you maintain the license to operate through management of ethics and regulatory framework? But when it comes to, what sustainable procurement really means is essentially to have clearer transparency, have a clear monitoring material sustainability risk in the value chain. And what we have seen is most organizations are starting to come out to see how they set the standards for their sub-suppliers. They would evaluate and say that, how many has been, not meeting the standards. Hence, therefore, they are being coached or they're being advised on how to enhance, the supply chain standards as well. And when we look at where the opportunities lies, essentially is to drive profit in terms of efficiency, accelerating the sustainable business solutions, to actually handle significant perception. How do you position in the market for transparency in your supply chain management, and to essentially also grow and drive the performance, attracting new talents, ensure customer satisfaction, that you are essentially the brand to come in together and be aligned with. Looking at, in terms of building facilities and management, the consideration is the need to actually plan and mitigate physical risk on your buildings and facilities. We had the flood in January, a massive flood, and a lot of operations and branches of financial institutions are impacted by flood. The question then is, how has those been factored in and considered? And when talk about, energy, carbon, and environmental taxes, how do you consider that as well, impacting your transition risk? And in terms of smart building and energy efficiency, we're seeing quite a number of retrofit being done on buildings, and the shift to renewable energy, putting solar rooftop panels, and as well as driving a lot of energy efficiency with automation in the smart building elements of the operations. So in terms of, occupational health and safety with the COVID, there's also a need to have the awareness, well-being, and there is a discussion as well on driving mental health and well-being concerns, especially in the lockdown situation. So what building and facilities management needs to have in terms of consciousness is really to invest in green technology and assets, consider what are the ways to actually coordinate the carbon footprint and energy audits of the assets, and what are the environmental health and safety considerations in the supply chain when people visit your facilities and building management. Where the opportunities are essentially with all these automation, it can actually optimize energy, carbon, and environmental taxes. And essentially is also to drive and reduce exposure to environmental disaster. You can actually help to actually drive renewable energy where it can be managed in a larger scale, and as well as handle the facilities for effective employee management. So when we look at integrating sustainability into human resources, what we see in terms of the drivers and trends are the digital and technological advancement in having better digital tools to enable the mix of on-site and remote working, which is quite critical in this space of in the current situation of lockdown. But with that rise up in terms of digitalization, there's also concern on cybersecurity and data privacy. There are also discussions about, the issues surrounding digital inequality and social fragmentation, driven by, educational disparities, unemployment, and gender and inclusion issues. So this is where it's essentially the human resources can also consider what the new climate economy would look like in terms of generating more jobs or new jobs, or how employees could then pivot to the new requirements of the low carbon and energy kind of low carbon economy kind of green jobs and green skill sets. So this transition is also to consider whether it can actually boost female participation to ensure a more inclusive employment landscape, and what are the new skill sets that comes with it. In terms of what sustainable human resource management would look like, is essentially to look at how they can reevaluate how the mobility strategies are being put in place, incorporate the risks and opportunities capability building cut across the organization, promote gender inclusion and equality in workplace, encouraging voluntary and green champions within the organization, drive sustainability training as part of a fundamental onboarding training, provide adequate training educational opportunities to boost adaptive capacity and reduce the vulnerability of them losing jobs where we pivot, and linking, more importantly, is linking remuneration and promotional opportunities that comes with sustainability practices. So when we look at opportunities, it's essentially capitalizing the gains from remote working to actually boost morale, motivation, and contribute to sustainable business by having more efficiency, creating green new jobs and allowing employees to pivot. It will definitely increase the market branding or perception of the organization when you clearly drive these values and have a clear ways to actually drive transparency in how you actually mobilize sustainability considerations in the organization. It will also help you to attract talents, have a diverse talent pool, and also reduce the needs of paper consumption, mobility, travel needs in that respect. So when we look at the next part in terms of the legal and compliance, what we see is, as I mentioned, a global direction to improve human rights situation. In terms of regulatory, there is increased regulation and standard setting that actually considers ESG management at the governance infrastructure. How these standards are being implemented, as well as how the communication are being done in an effective manner. How do organizations take responsibility on ESG management risks and opportunities? And it's always essentially as well to handle the greenwashing risk. And now we also hear the social washing risk as well coming up, and to also consider what are the risks of damage and litigation due to the externalities, climate change, and natural disasters. So what the sustainable legal and compliance would then look like is really to have that capability and competency to scan and understand what are the risks that affects the companies, to also drive how they can operationalize and manage the stakeholder expectation. We've seen more enhancement on having a stakeholder management strategy and policies being put in place, as well as having the knowledge of the entire legal team to be aligned to sustainability issues management, and to also regularize the internal engagement on sustainability issues. And moving on to opportunities, what we have seen is it would help to mitigate the cost of non-compliance with any ESG laws and regulations, to also grow and improve the inclusiveness of the policies, to drive connectivity in having a diverse talent pool, intersecting with human resources, and to manage the transparency of disclosures and strong compliance with laws and regulations. Now, last but not least, in terms of marketing and branding, which is essentially quite critical for most organizations, is there are increasing negativity in terms of publicity as associated with poor ESG risk practices. There is also a consideration of whether there are greenwashing or essentially not having that transparency in, for example, the products that is being put in place or the green investments that you actually commit to. So this is essentially to also understand what the customers, regulators, investors, or all stakeholders are now looking for. What are the information that they are requesting to be put forth to public, and how the COVID-19 has accelerated the momentum to have ESG being brought up to a higher increased part of how these financial institutions are driving the force of change. And you see that in terms of the platform infrastructure that marketing and branding are using, there's also an increase online banking apps. So this will actually need to weave in the consideration of how you actually communicate ESG management. Now, in order to look at how a sustainable marketing and branding will actually evolve, there would be a clear direction to actually enhance ESG transparency ensure that there are specific tangible commitments and goals that aligns and connect to the products and services that are being offered. And you can essentially, the organization communicate the results and outcomes in a timely, effective manner with clear timeframes. There will also be, a significant increase on how do the organizations educate customers on the benefits of ESG products, as well as embrace the digitalization to provide the enhanced value as well. Of course, when you look at the opportunities, it would help to actually enhance your market positioning when you offer measurable results to support your commitments. You are also able to then look at what are the various avenues of customer satisfaction that you actually can capture. And most organizations we see in the market who are leading on marketing and branding, they start to put out in place how strong do they evaluate their relationship with key stakeholders. So this is where the strengths and the surveys and evaluating the stakeholder management strategy comes about, and how do you then inform that results to the public. So with that, I will pass on to Ms. Suzanne Biegel, who's the founder of Catalyst at Large Expert, to actually take us through the Gender Smart Investment chapter. And over to you, Suzanne.
Good afternoon, all. I'm so delighted to be here to speak with you today as one of the technical partners for the ASEAN LCEP, and I want to thank EY. My name is Suzanne Biegel, and I'm the co-founder of the Gender Smart Investing Summit, a global initiative to unlock gender smart capital at scale. And today I'm going to speak with you about the nexus of climate and gender finance and the urgency and importance of bringing these two themes together. And I'm going to be pulling from our report, Gender and Climate Investment, a Strategy for Unlocking a Sustainable Future. Next. Let's get started by talking about the context for the growth of the field, the urgency of why it's so important to consider the nexus of gender and climate finance, and dive in. Next. You've already been speaking about climate change, climate finance, but most climate finance is not yet gender smart. Next. There's a huge demand, of course, for climate finance to facilitate and accelerate the transition to a low carbon economy and a resilient economy. And at the same time, we need to be conscious of how climate impacts different communities disproportionately. The poor are especially vulnerable to the effects of climate change, and the majority of the 1.5 billion people living on the planet under $1 a day are women. Gender-based differences in women's and men's vulnerability, as evidenced by mortality rates in extreme weather conditions caused by climate change, stem from gendered norms around mobility, skills, employment, and other factors which limit women's participation and access to resources and economic opportunities. But we must not only see women as victims of climate change. Tackling of gender inequalities can positively influence climate action. And as a study from the IMF shows, policies that improve access to educational opportunities and finance for women can lead to a reduction in not only inequality, but an increase in economic growth for the developing country. One Brookings Institution study suggests that for every additional year of schooling a girl receives, on average, her country's resilience to climate disasters increases. Why is this? Because she can make educated decisions about sustainable choices and preparedness, resiliency. For example, an educated farmer can make different crop decisions and financing and irrigation. Next slide. Finance can deliver enhanced climate and gender impacts, but beyond this, climate and gender investing is just smart investing, period. And by bringing these lenses to bear on investment decisions, we see the potential for increased returns and decreased risk. And we've articulated 5 reasons. This is not a hierarchy. We believe these are all important, but these are some of these are more relevant for others in looking at different investment actors and actions. First, integrating climate and gender investment approaches can help to uncover new investment approaches. Women innovators and entrepreneurs are creating disruptive solutions, and addressing gender in a product or service solution can unlock products and services that are more responsive to market needs. It's also about mitigating risk. Climate risks cannot be diversified away. They affect all businesses, whether directly or via customers, suppliers, and communities. And failing to address gender can be a source of market risk, operating risk, or even reputational risk. Companies or funds may fail if they brush off the gendered needs of employees or customers or suppliers or other stakeholders. And gender smart and climate smart investing provides ways of mitigating those risks. It's about meeting investor expectations. It's about driving long-term value, because a gender and climate lens can drive competitive advantage and long-term value across talent, innovation, markets, products and services, value chains, and governance. And as climate and social impact enter mainstream thinking, regulation, and policy, those who fail to adapt at risk falling behind. And finally, of course, amplifying social impact. Looking at gender equality and climate action cuts across so many other SDGs, and all development finance, and indeed all finance with the SDGs as an objective, is beginning to recognize that gender is a cross-cutting theme. So we believe that long-term, there'll be a correlation between these companies driving positive social returns and having an increased impact on financial returns. Next slide. I want to share this quote from Mark Carney, which you can read yourselves, the UN Special Envoy on Climate Action and Finance and former governor of the Bank of England. Mark Carney is an international gender champion who is pledged to champion the use of the 2X Gender and Climate Task Force tools on climate and gender, and to champion better access to climate risk training opportunities for central banks and supervisors, particularly in emerging markets and economies. Next slide. Both fields are growing fast. I don't need to tell you about the growth of the climate finance field, but I will tell you about the gender lens investing field. We estimate that by the end of 2020, there was more than $18 billion in public and private investment vehicles moving with a gender lens. And this chart illustrates the growth of those vehicles. And these two areas of climate and gender have tended to operate in silos, but the integration of the two can unlock tremendous opportunities. So we ask ourselves, what if all of the capital flowing into climate finance today had a gender lens? To build a realistic picture of the opportunity to bring these together, critical data gaps are there, we recognize that, but we have the opportunity to be carving out new solutions and examples across ASEAN. Next slide. I'd like to take a second to highlight the ASEAN region as an example of a way to bring together gender and climate. The East Asia and Pacific region is the largest provider and recipient of climate finance globally, with 250 billion USD, comprising 44% of total flows. And gender lens investing is up 160% in ASEAN, with 22 active gender lens investing vehicles across public and private markets at a total of 1.1 billion USD. In addition, annual flows of 250 billion into climate-related projects represent a huge opportunity to significantly scale up gender lens investing in the ASEAN region, although it hasn't happened yet, through ambitious gender-related KPIs being intentionally integrated across all climate finance by default. And some of the public capital providers have made some commitments in this regard, but to date, this opportunity really remains largely untapped in the ASEAN region. But it presents a significant opportunity to be a leader, both for women and for the world, and for climate outcomes that we're really looking for. If you go to the next slide, I want to talk a little bit about some of the principles around applying these lenses. Next slide. So this is about bringing together a climate and gender lens together, not only in what we're investing in, but who has a seat at the table, and what kinds of companies, what kinds of funds, what kinds of ways this comes out in an infrastructure project, and where financial institutions have a role to play. There are a few different ways to think about this. One is to apply a gender lens to climate finance, existing climate finance, and to think about how do the company's products and services or value chains really impact the lives of women and girls. You can also apply a climate lens to gender finance. So thinking about where gender bonds, gender specific investment vehicles are, and think where are the green opportunities within those opportunities. And then really thinking from the very beginning to bring gender and climate together. Are there gender specific opportunities to improve climate and business performance? And what would you look at? You would again look at leadership, you would look at governance, you look at supply chains and employment, you'd look at customers and communities, and you'd be thinking about where might I be spotting an opportunity by paying attention, or spotting an opportunity by spotting a risk where I'm not paying attention. And I'll get into that a little bit more. Let's go to the next slide. The key actors in this ecosystem are, of course, all of the finance providers and capital providers, from the central banks, the DFIs, foundations and family offices, the fund managers, but the intermediaries, the coalitions and networks, the consultants and advisors that are bringing these kinds of products to market, and the movement building actors. And then finally, of course, on the company side, to really be looking at businesses across ag, across energy, across transport, across manufacturing, circular economy, sustainable cities. And I'm going to talk a little bit about how this comes to light in that ecosystem. If we go to the next slide, money's already moving, and pioneer investors are leading the way here. So the DFIs, there is a set of DFIs that have collectively committed 15 billion in capital to move with a gender lens, and significantly as well with a climate lens. In 2018, they made a commitment to move 3 billion in this direction, and had already moved 7 billion by the end of 2020. So this 15 billion is a new commitment. The multilateral development banks are now part of that new commitment, but they've already been acting. EBRD, European Investment Bank, IDB Invest in Latin America, the IFC, Asian Development Bank, and African Development Bank. And then funds, there are a tremendous number of funds. We're tracking more than 25 funds around the world that are already deploying climate and gender lens. And I'll talk about a few of them. And then of course, across public markets, looking both at climate and gender in an ESG context. If we go to the next slide. So you can be thinking about this from this point of view of spotting who are those entrepreneurs and innovators that either we need to be backing through venture capital, private equity, through bank finance, that can be in corporate supply chains, it could be in public sector supply chains. It might be that it's a women-owned business or women co-founded business. It might be that it's really about women in leadership. It might be about the fact that their products and services are very focused on paying attention to women customers as well as male customers. It could be really thinking about where are women in those supply chains, again, either as owning companies or as running companies or as employees in companies. So we're thinking about all of those lenses. And if we go to the next slide, and across, as I mentioned, every area of climate finance, from energy to ag to water to transport and on. So this is not just siloed in one particular area. Let me tell you about a few case studies. Agence Française de Développement, if we go to the next slide, has been working to scale up gender finance through mainstreaming gender considerations in all new sustainable bond issues. In this case, a use of proceeds bond. This would mean including requirements on gender diversity and the eligibility criteria used for the selection of projects. For sustainability linked bonds, this would imply using an additional set of key performance indicators and sustainability performance targets in the gender bond framework, along with the environmental or KPI, the environmental or social KPIs. The integration of gender considerations in the green bond framework is a novel idea. Therefore, to date, there have not been very many examples that can serve as best practices for other green bond issuers. However, there's some promising examples. Agence Française de Développement has developed a new SDG bond framework for green, social, and sustainability bond issues in October 2020. To date, AFD has only used this framework to issue an SDG bond. Therefore, instead of a green bond, this will be used as an example of how a green bond framework can integrate gender targets. Considering that AFD has been an active green bond issuer with a total insurance side of euro 3.25 billion since 2014, we might see new green bonds using this new framework later this year. And among other eligibility criteria, the bond framework requires new projects and loans to receive a neutral or positive grade in 6 sustainable development dimensions, which include gender equality alongside climate objectives. So we're thinking about access to services, control over resources and income, access to justice, combating violence against women, participation in economic, social, and political decision-making bodies, and project governance with regard to gender. If we go to the next slide, Schneider Electric, a French company focusing on energy management and automation, can use the proceeds of their sustainability-linked bond for general corporate purposes. And at the same time, it has a strong incentive to meet the SDGs it is committed to in its bond framework. If it doesn't meet its minimum KPI score threshold by 2025, there'll be a margin step up or a premium payment as outlined in the transaction document of each issue. And the KPI minimum score threshold represents on average an 85% achievement for each KPI, which corresponds to an average score of 9 or 10. This is calculated by first giving a performance score to each KPI on a 10-point scale. The equal weighted average of the scores for the 3 KPI determinants determines whether the KPI minimum score threshold has been met. And Schneider's example to show how you can integrally link a gender KPI, a climate KPI, and a training, an employment KPI is a model that you can really look at. Next slide. There's no single path to an integrated gender and climate investment approach, but the risk of waiting for the perfect opportunity or data or project outweighs the benefits of acting now, whether testing the waters within pilot project or scaling up what it is to be done. So I hope this has given you a little bit of a flavor for how we bring gender and climate finance together, and I wish you good conversations this afternoon.
Thank you, Suzanne, and thank you also to Arina for her presentation earlier today. And that brings us to the end of our session this afternoon. I do hope you've enjoyed it. I do hope you've had some useful information. I do hope you're looking forward to and will engage in the remainder of discussion this afternoon and over the next 2 days of the conference. With that, I'll say good afternoon and enjoy the rest of your day.
Thank you, Russell. And I hope you all found this session useful in understanding how the finance sector can operate, moving forward. What has been operating in the past may not be sufficient to actually take us through towards the low carbon economy. So this actually covers some of the various aspects. I hope you have gotten quite a good amount of thoughts, ideas, and focus areas that you can actually consider in driving the institutionalization of climate-related strategies in your organization. And I also hope that from this session, you also found that there are essentially a few ways already being put forth for how to actually apply a gender-smart lens in some of the products or the strategies that you're also looking at. So for the next session, I would like to take us through to welcome our next speaker, Junior Cho. Junior is the CEO of Zurich General Insurance Malaysia. He is responsible for driving Zurich's business strategies to achieve profitable growth for its general insurance business in Malaysia. So Junior is a seasoned industry leader with more than 25 years of experience in the insurance and financial services sector. He has held various strategic and senior management roles in multinationals such as MetLife International, Allianz Life, and Cigna International. And I would like to also quote from his recent LinkedIn message, the message that he also is advocating is the urgency for us to collectively act is unwavering, while the impact of our hesitation or delay is damaging. And so without further ado, I will pass on to Junior, but I will also say that we are also blessed to be also joined by Teresa Wong, who is the Chief Risk Officer of Zurich General as well. So Teresa shares the same drive in advancing climate risk management and other critical social efforts like EPIC Society Program to support the Orang Asli initiative. So without further ado, I'll pass it on to you, Junior and Teresa.
Thank you, Arina. So thank you, everyone. I'm blessed here to be sharing the stage with Teresa. as well as each of one of you joining us in the conference. I'll dive right in, and our focus is really talking about applying sustainability in insurance. And for us, hold on, let me just get the presentation. For us, what we'd like to do is share the story in terms of what Zurich is doing globally to give you some context as well as what we're doing in Malaysia. We hope that this is very helpful. For us, we would like to share that journey in terms of what Zurich has undertaken, have a little discussion in terms of what our role is in the climate change and sustainability aspect, and then share the roadmap in terms of how we're moving towards that transition, and then talking a little bit about the sustainable products and services that we are looking to develop as we move forward, and then share a little about our impact to date. So when we talk about sustainability, I won't define what sustainability is, but our ambition is to become one of the most impactful and responsible companies, which is a very big ambition, and a lot of a common ambition that a lot of the big companies do have. And really, it's about safeguarding the future for not only our company, but the society. And that society can entail our employees, our customers, our partners, and in the communities that we serve. So I'll focus more in terms of why are we doing this? And there would be a common thread for a lot of the companies that are out there, but also what is it that Zurich is embarking on? So for us, our vision is creating a brighter future together. It's really about making sure that we can serve and protect the lives of our customers, our employees, and our partners. And with that vision, sustainability is the only way that we can really continue that on. And for us, that's central to our purpose in terms of how we want to differentiate ourselves and where we see our growth is. Now, this purpose allows us to unify all our customers as well as our people for a shared vision. And for us, that's extremely important. But I think what's also important is that the regulators and the investors are finding themselves much more attuned to the needs of sustainable growth for their respective markets. And for that, they have higher expectations, especially for companies like Zurich. Now, I will tell you that Zurich is one small piece of a larger kind of collective, and we are just proud to play a small role in contributing to a global movement. And we see that sustainability is a way to differentiate ourselves. If you look at whatever data that's out there, the expectation of the younger generation consumers is that they expect whichever products that are undertaken or purchased, that they would expect it to improve their lives. And as a result, the expectation in terms of what the product providers are providing, what service providers are providing, are much higher. But the reality is that the consumers do not feel that the brands are doing so. So we believe that there is an opportunity to differentiate ourselves from the market. Now, as part of driving that sustainability, the key driver here is about innovation. And for us, we'll talk a little bit more in terms of what are the things that we're doing as a way to kind of differentiate ourselves. Now, our Zurich sustainability framework is really centered across three main pillars that bolsters the creating a brighter future together. So the first, obviously, is our focus on climate. So our 1.5 degrees Celsius future, which is about focusing on that transition to climate neutral. The second is about work sustainability. So as the world changes, which we've seen during the pandemic, the emphasis and the importance is much stronger now in terms of supporting our people and the businesses that we have that are around us. And the third is really with the digitalization and the advancements and the speed in which where the countries and communities are moving, is that we need to ensure that there's confidence in terms of the foray into digital. And that's really about stewardship of the data, customer data, and making sure that there's ethical utilization of the data that's afforded to us. Now, our journey started about 14 years ago, and we took baby steps with key actions with unwavering commitment. And for us, it's as an early pioneer, we want to take that leadership in terms of climate. So we've done things such as be the first insurer to sign the business ambition for 1.5 degree, the pledge, taken the lead in terms of the Net Zero Asset Owner Alliance and so forth. Now, what that's translated to is recognition, and that recognition is less in terms of the statistical side, but more in terms of affirming that our purpose and our journey is on the right track. And we're here in terms of a long-term commitment in serving our customers, our employees, and our shareholders, as well as our communities. Now, I'll move into in terms of what the role is for climate change and sustainability in insurance, right? So why does it matter? And you've heard this from a lot of the speakers in terms of the brand reputation We talked about in terms of reaffirming our purpose and ensuring that we can engage positively in terms of having that positive contribution and business opportunities and risk and return. But really what it is about doing the right thing. And the roles of the insurers and Takaful operators is quite big, right? The customers are expecting us to have much more involvement. The investors have seen higher returns with those funds and stocks that are tied with high ESG scores outperforming the market, so that we want to have ourselves held to a higher standard, as well as for those funds that we are investing in, that we also have a similar outlook. And the regulators are also making sure that there's sustainable finance regulations just from a long-term perspective. So it's not a one-sided effect. It's the acceleration of multiple parties coming with a common kind of vision is really accelerating the change. Now, the three pillars I talked about, just to give you a little bit of color in terms of why, as the first insurer to sign the UN Business Ambition for the 1.5 degree pledge in 2019, it's really three parts to it. What we want to do is really reduce our CO2 emission targets. So we've set personal targets within the company in terms of migrating to renewable electricity, electric car fleets, steering in terms of internal carbon fund, really guiding our investment portfolio as real targets and ambitions. The real focus in terms of launching sustainable solutions, and this is propositions both from a product and service offering standpoint, and delivering solutions for customers in terms of tool sets to quantify and qualify a lot of the impact from climate. And that includes looking at our risk assessment frameworks and really bringing in a lot of the complexities so that we're able to provide that advisory service in terms of managing risks for our customers. The second pillar I talked about in terms of confidence in the digital society is honoring the trust that's afforded to us by the customers. So delivering on our data commitments and making sure that the use of AI is within the ethical bounds that's expected from our customers. It's making sure that the data that we do have afforded to us through our ecosystem of partners, as well as our customers, are highly protected, and we do our utmost to uphold the safeguards of cybersecurity. And last but not least is really about the business resilience and further foray into the digitalization. The third part we talked about is on the social side. So where we want to do is embedding our work sustainability principles, and this really has to do with the evolution of digital into our businesses would mean that certain positions that used to be around would now have to transform, and that would require upskilling and learning opportunities and replatforming of skill sets for our people. So we want to make sure that as the evolution of technology occurs, that we're future-proofing our people and our organization to ensure that they can navigate through the kind of world of work and professionalism and career growth as we look to adapt to our customer needs. So for us, it's building out the foundation to ensure that the workforce of yesterday continues to remain relevant and we continue to address the changing needs of the consumers. Now, this is all great, right? So what does this mean? It's a long-term view in terms of how we act. And one of the things that really resonated with me was the importance. I took down some notes. Let me see. The biggest risk is inaction. And one of the favorite quotes I have is progress over perfection, which means that we have to make and continue to make baby steps. For us, it's a long-term game. So when we look at climate impact, we looked at modifying our climate management framework as well as our approach. We are incorporating climate risks in terms of our underwriting and investments. We hold ourselves and our investees into a higher standard. So when we engage with customers, we make sure that it is alignment with our climate kind of policy. In 2020, as an example, we engaged with over 260 companies to advise them of our thermal coal and oil sands policy. And that required that we had to divest the relationships, 36% of those relationships. Now, this is just a start. And we hope that this collective movement by the industry will help move us into the right direction. Now, being a global leader, we need to ensure that we have responsible investments, and that really is focused on three areas, not just the integration of the ESG risk and opportunities across all the asset classes, making sure that we make relevant impact investing. For us, we've set aside $5 billion as an impact portfolio target. In Malaysia, about $100 million are in green investments portfolio. And in terms of advancing forward is making sure that we lead the front to make it impactful by using our resources available to us to gently push not just our peers, but also our partners towards this long-lasting change. So what does that mean? So sustainability, I talked about embedding it as part of our underwriting consideration. Now, it's not just about doing the right thing, but looking to ensure that we can add economic value. So when we first embarked on this, in 2012, we took a deliberate approach to have a stand on certain positions, whether it's banned weapons, dam construction, oil, gas, and mining, particularly in the environmentally sensitive areas, and evolve that position in 2017 and 2019 with the plan to review that every 2 years. And really, this is about engaging and developing that position as new data points evolve to assess whether we continue relationships, whether we advise those consumers in terms of how they can mitigate and move off of that transition or support that transition, I should say, or whether we need to divest in terms of those relationships. And we developed a carbon intensity methodology in terms of making sure that we can help clients transition off of those portfolios. Now, it sounds easier said than done. And for us, it's really about adapting existing portfolios that we have, as well as looking to innovate on new ones. I know that a lot of our peers in the industry are looking to do so. One of the things that we have launched is a climate change resilience service. So this is about providing qualitative and quantitative support in terms of how clients can approach in terms of mitigating the risks associated with current as well as future exposures related to climate. And it's a service that we extended for all our companies, our partners and clients globally. Now, there are a lot of drivers also in terms of that's forcing us to really rethink our proposition that way in the market, and this is globally. The green recovery or the push for EVs and hydrogen vehicles for renewable energy. A lot of the countries that are moving towards the net zero and the policy making that's accelerated by COP26. Heightening customer expectations and the demands of, what it would mean to them and to their families and to their communities, and the evolving regulations in terms of the regulators expecting a higher kind of stance and outlook and planning. So to give you a little bit of viewpoint, there are kind of 4 phases that we have, and some of this might resonate with some of the other insurance partners that we have here on the panel. But really, if you look at retail and commercial, there's some early concepts that we're looking at, things such as the offsetting of the service in some of the more mature markets, carbon footprinting platform for SMEs, and on the commercial side, evolvement of parametrics. Things that are in development, we have some sustainable infrastructure cover on the commercial side, sustainable farming as it relates to agricultural covers. And on the retail side, some of the parametrics and even the electric vehicle charging stations covers as part of the mobility ecosystem are things that are in development. We have a number of things that are live in the market, whether it's e-scooter, e-bike, some simplified parametrics as it relates to earthquake, haze, some solar-related covers on the retail side. And on the commercial side, we do have green construction-related covers that we have. Now, what we're continuing to evolve are some of the more simple type ones that we have launched before, whether it's a one tree, one policy, green telematics, or even just electric vehicles covers are things that we're evolving. Now, these are nothing new, but the idea is that as we gather more information and as the ecosystem of partners become more mature in terms of the services that they're offering, we believe that these are building blocks in terms of providing much more value and impact on a collective level. So 2 examples that we have, I know I rattle off a few, is sustainable infrastructure policy. So there's a builder's risk policy that's really focused around infrastructure projects that meet the sustainability standards. Some of our global customers, our clients, have asked this from us, and we've noticed that with some of the green financing trends, some of the borrowers have been able to lower their financing costs as a result. On the retail side, it's no secret that with EV vehicles, the mobility ecosystem is an area of interest. So whether that's just the vehicles or whether there are platforms as it relates to incentives, some of the services, the CO2 offsetting platforms are some of the pieces that are into play that the ecosystem partners are looking to develop and to advance. We're seeing much more traction and speed in the more developed markets, but overall, globally, we are seeing quite a bit of interest. One other thing that I've not listed here is we do have one item which is related to microinsurance, and this is related to climate risk. And this is a proud collaboration we have with Nestle. That collaboration, let me just refer to my notes here, is related to a crop insurance, the crop insurance that's related, that's focused on blue marble, right? So it is related to coffee farmers. With the impact of climate risk, they are able to get some form of protection to not impact the livelihood of those coffee farmers. And that's been around for a number of different years. So it's little schemes and propositions and service offerings like this that we're doing globally that we hope is looking to make an impact. And some of these propositions are ones that we're evaluating for the Malaysia market, as well as in ASEAN. Now, if I translate this to what we're doing here also in Malaysia, flood resilience, Zurich has undertaken a global flood resilience program a couple of years ago in 2017. The view is that we will be impacting about 5 million customers globally by 2024 to have a positive impact. In Malaysia, what we've done is we've launched a flood resilience program to really ensure that we protect and we care for our customers, particularly in the East Coast and East Malaysia. We call it Being There When It Matters the Most claims program. And the idea is we launched this last year, and when we get notices of floods, we dispatch these trucks that would provide on-the-spot claims approval for up to 30,000, as well as prompt processing. And we've seen that we've supported 124 policyholders with a payout of claims at 1.4 million. Now, these are on-the-spot approvals that go out to help consumers at the point when they need it the most. We do have 24-hour flood claims call center that supports them, as well as flood relief items to get them through the moments that they need it the most. As part of CSR, we've looked to serve the communities, and with the pandemic, we've taken a pivot to ensure that we can sustain those communities. So our Eat Right to Play Right is really focusing around nutrition and instilling healthy habits. But when the pandemic came about, we could not, and this was a football program, we realized that face-to-face was not doable. So we rediverted our investments to supporting the families that are impacted. So the grant since 2016 has been about 13 million. Since COVID occurred, we've supported 375 families receiving monthly aid. The second part is obviously addressing the underserved, and this is related to the Orang Asli. We've done home building, and during the COVID period, provided support. So we've helped support 82 communities across 5 states, not just Zurich, but with our grant partners, as well as with Epic, in terms of providing a more sustainable living during the difficult times that these communities have been facing. As many of you may know, Zurich Malaysia also on the P&C side has Zurich General Takaful. And one thing I'd like to highlight as part of BBIT, which I believe is a topic afterwards, is that we're doing our part to ensure sustainability, financial sustainability for the participants that are customers of Zurich General Takaful. So for us, we have a hybrid model, which is a combination of the Mudaraba and Wakala models. And since 2018, for the last 3 years, we've declared about 19 million, almost 20 million ringgit in surplus payments to the participants. We're extremely proud of doing this and view this as something extremely important in terms of giving back and sustaining the communities here in Malaysia. Now, the last piece I'd like to share with you what we're doing in terms of to wrap it all in is that beyond just focusing on climate as it relates to our customers and our partners and propositions and services in the communities, Zurich has undertaken a project to become the exclusive sponsor on a reforestation project. And it's something that we're extremely proud about. So we are partnering with a nonprofit called Instituto Terra. The aim is to plant 1 million trees to reinvigorate the biodiversity of the ecosystem. For those that do not know, about 7% of the Brazilian rainforest actually remains. And the focus is that with the contribution to this reforestation, up to 120 native species plants will kind of regenerate, and we'll bring back about 250 animal species back to the Atlantic forest. And we're really hoping that this has a contribution, and in terms of doing our part of helping to drive the biodiversity that will capture the carbon from the atmosphere. I'd like to take a minute to stop here to share a little clip to give you the highlights of that sponsorship. I don't see the video, so I'm not quite sure if the video is being played.
Hold on, yeah, Junior. We are actually pulling up the video. So Junior, maybe while the video is being pulled up, I will, if you don't mind, I will maybe ask one question from the floor and panelists, if that's fine. The questions that we have from the floor today is, appreciate if you can share what are the offering of the parametric and crop insurance that is being, what kind of crops are being covered by Zurich's offering?
Sure. So in Malaysia, we do not do crop insurance at the moment. There was some interest about 7 years ago, but that has not taken fruit. In the US, farmers, we are the #2 crop insurer in the market there in collaboration with the federal government. They have been advancing the crop insurance to support sustainable farming. So I believe there's wheat. I don't remember the crops off the top of my head, but we are the #2 there. In some markets globally, we do support it. So in the case of the coffee farmers, in partners with Nestle, who is a global partner of ours, we would look to provide schemes to support those coffee farmers, provided that they are upholding some of the sustainable practices, whether it is the legitimate use of workers above the minimum age, so minimum standards that need to be upheld. We do provide those types of cover. On parametric, for example, in Japan, we do have an earthquake parametric cover. For something like that, we are partnering with the utilities company to offer that protection. As you know, Japan is highly prone to earthquakes, and that's a cover that we do list. Some of the things that obviously in Malaysia will be relevant would be things such as haze and flooding in terms of parametric cover. So that's something that we're looking at. I wouldn't be surprised if others aren't looking at it, but those would be the covers that we think would be relevant for Malaysia.
Sure. I think thank you, Junior, for sharing. Maybe we'll let the video play and then we can continue the conversation.
Sure.
Thank you, Junior. Maybe I'll pass it back to you because I think you want to take us through the remaining of the slides that you have.
Sure. I hope that video resonated well with many of you. Just as a personal note, I grew up in Venezuela when I was really young, and I was fortunate enough to visit the Amazon forest. So when I saw this video, it really resonated. And as a father, as a husband, and as a brother, I looked down at my kids and my friends' kids, and I realized that there's a sense of obligation and purpose, especially in the pandemic, in terms of making sure we do the right thing. So sustainability efforts that we're doing at Zurich really resonates well with me as well as our 1,600 staff. It is certainly a journey that we're taking. By no means are we the most perfect, but our ambition and our vision certainly reaffirms in terms of what our purpose is. And what it means is that in terms of our impact, the key is to ensure that we're delivering those babies, that we're working on those baby steps and making solid progress across four major areas. One is as an insurer, right? So doing our part to align our group-wide ambition in terms of climate approach to what we look to deliver, whether it is to enhance the way we assess risk and improve the carbon footprint with the industry bodies, having a firm stance in terms of what we stand up for in terms of what is right, and really driving that product innovation. For investors, really making sure that we increase our investments in our green investments and making sure that we make impactful change to the investment community through what we're able to do as investors. But more importantly, making sure that the staff that dedicate their day in, day out to the Zurich brand and servicing our customers as we navigate through what's happening around us globally, is that we prioritize the safety and well-being of them. And it's not just about COVID, right? It's about the evolution and the pivots that are happening within the industry that we need to make sure that the employees feel supported. And whether that is gender diversity and gender inclusion, whether that is upskilling of skill sets, we need to make sure that we feel that the employees are protected and they're part of the Zurich family. The last one is really about continuing our commitment to the community. And I talked about the Global Flood Resilience Program. Our aim, since what we've launched a couple of years back, is to really have an impactful outcome, really reaching out to 4 million people by 2024. And our Zurich Foundation, leveraging that foundation to really make more of an impact in the communities that we live in. So there's been some support for charities during the COVID-19. Some of you may know that we've partnered with another agency to do distribution of vaccines globally to the underserved and the underprivileged. So for us, with that, our pillars remain firm. We won't rest on these achievements. We hope that these achievements will inspire others to take on the mission and to do more, whether it's globally or even locally. And our targets remain firm. It is to align our business to the 1.5 degree Celsius future, reduce our emissions by half in 2025, which we are ahead of schedule. Our investments to reduce CO2 emissions in green building investments, as well as the equity and credit side. And last but not least, making sure that we take care of the people and the community, especially during these trying times. That concludes my discussion. I do know that there's some questions, so I can take on some questions if that makes sense. Arina?
Yes, Junior.
Okay.
Thank you very much for a succinct summarization of your key milestones. And I would like to, continue from the milestones that you shared. We have today over a 400 audience that is also, keen to understand from this breakout group, this work stream is, given the achievements that you had and you've been on this, Zurich has been on this for 17 years. How have Zurich overcome, what are the biggest challenges over the 17 years, especially in the Malaysian context? If you have, what comes to your mind?
Okay, well, the 17-year journey was a global journey. If I look at Malaysia, I would say Malaysia has a very strong ambition, and we admire that the government and the regulators are pushing. I'm part of the JC3, SC3 committee, and it's a privilege to help contribute to that. we believe that there's a lot more work that I think that the regulators and the governments can help to support the evolution. I do believe that the industry needs to continue to make a concerted effort to make that change. Part of it has to do with education with the consumers. Part of it is our part to ensure that we have deliberate and concrete and concise plans to make that impact. You know, the idea for the flood trucks, for example, was not a deliberate, let's focus on what we want to do from a flood resilience. It was a very simple idea that one of the staff members came up and said, wouldn't it be great if we had trucks that can serve in the instant that these floods happen, that these trucks can be there in the communities when it's most impactful. And we have WhatsApp as a way to communicate, to pass the word. We have our branch managers, our agents and so forth, and it just happened. So I think what we need to have is a cultural mindset where everyone plays a small part in terms of making a meaningful impact. It's not about just the companies and the brands and just the regulators. It's about everyone taking that small step to make a larger impact for the industry.
Yeah, that's a very good context, because I think the idea is not to develop products and recommend it to the society, but really understanding what the societal needs are, what are the gaps, and then, you know, customizing what are the solutions that, you know, is fit for purpose for those gaps and where it matters the most. If you don't mind, I'll bring you to the next question, which gets more to the critical insurance and Takaful sector. So in terms of insurance and Takaful, how can the general insurance and the considering having the underwriting considerations, how can life insurance and Takaful start to integrate sustainability concepts into the underwriting considerations?
So it's a very broad question, because you can tackle it in many different ways, right? If you look at just in terms of the ESG approach, you can take it from the environmental side and climate side, right? I mean, do we underwrite certain agricultural or companies if they do not have sustainable farming practices, right? As an example, and we know that that's something that is up for kind of a question mark. But it also can be, are we offering affordable usage-based insurance to the gig economy, right? The gig economy is an evolution where we need to sustain a new emerging working class, right? And is there something that we need to be able to do there in terms of developing? And the underwriting practices are completely different. I think what's going to be important is to identify what are the areas that we stand for and where do we want to make the most impact and play that role. And by virtue of really problem solving it that way, you would be able to identify what the underwriting considerations would be. I mean, I could sit here and spend actually a whole day on this, but I think it depends on where you want to make the most impact, whether it's societal, whether it's environmental or governance, and then that will dictate kind of the flow of where we need to make those changes.
Understand, Junior. Maybe I'll go on to the other flip side of things, where when we look at shareholder from the investment side perspective, when we look at shareholder activism and engagement with companies that you also mentioned, essentially is driving your business partners to also start to consider and move. What are the key challenges and how do Zurich maneuver, especially in your earlier slide you mentioned there are existing companies that have been flagged up with ongoing reviews, especially if they're in the coal and oil sands position. What would be your advice in handling such engagements?
So what I have to do is, so I've talked a lot in terms of what the company can do to help drive the sustainability. A lot of what you are asking right now is, what are the potential risk exposures that we have if we were to support those companies? Maybe I'd like to bring in Teresa for her to kind of share her thoughts and be able to answer that question. Teresa?
Sure, Teresa.
Yeah,
great.
Yeah, okay. Thanks, Junior. So basically from the perspective of, not providing insurance immediately, or you just stop providing cover for companies who are in the transition stage would be quite, quite terrible, right? So the way Zurich starts the conversation would be to engage with the customer first, i.e., what are your sustainable plans for the future? How are you going to green your practices? What kind of sustainable work practices you will embark on before we further the conversation? And it would not be a straight away date cut, but there is a transition stage where both parties will agree to and come to an agreement and say that, okay, this is the time frame we have for moving it forward. It will be no different from how a banker would review a loan to a borrower, right? So what kind of sustainable practices would they kit out the say palm oil plantation with machineries, or the methodology of replanting, for instance, right? So all these have got to be discussed at that level. It's not one party saying no and then end of the story, but it's got to be an engagement. So that's a very important transition phase that has got to be engaged. Yeah.
I mean, if I can just add one quick thing. I think the other thing is that in Malaysia, I think we can do more. We wish there were more choices, as if versus, let's say, some of the markets overseas. So this is where I think the regulators, the banks, and the FI industry can help support this, so that it becomes much more circular in nature, right? We've made $100 million in terms of green investments. We can certainly do much more. And that's, if we're able to do this as an industry from a financial services standpoint, I think that the snowballing effect will have a much greater impact at a much quicker speed.
Yeah, Arina, if I can jump back to the question about life insurance and Takaful, that would be a key point if they've got investment-linked products and they could use the green investments rather than just the conventional ones, because we've got track records showing, I mean, globally, that the outcome of sustainable green investments are also quite high, and if not better than the conventional ones. So from a Malaysian perspective, this would be one area that they could explore. And granted that there are limited green assets around to be had, one area that the investment or asset management companies could do together with FIs is to grow this base of green investments. Yeah.
I guess I appreciate, the context, Teresa and Junior, that you're sharing, at least especially for Malaysia. But the one quick question following up from the floor as well is, do you then see any challenges for corporate clients to get insurance coverage in the future if they are engaged in critical industry segments like coal and palm oil? So I know you mentioned about the nuances and transition consideration, but essentially I think where they are coming from is more of like, how critical would that transition, would it be intensified, or are you looking at the pace that is very much customized in Malaysia?
So okay, so the short answer is, from a Zurich standpoint, for coal industries, we do not. We took a stance to not insure. As you see, a lot of the insurers that are signing up globally, especially the multinationals, that stance is very clear, as well as the large players here in Malaysia. So right now, if you would ask me today, will I still get coverage? The answer is, of course, at a price. Will you get coverage 5 years from now? I would probably not look to bet on it. I would probably look for people to pivot, no different than what other companies are doing. Schneider Electric that we saw. There's a lot of different companies that are out there globally that are moving from the old coal to now wind farms or solar as well as wind, renewable energy. And I do think that it will be difficult. That pace is certainly accelerating more so than what we've seen in the last 15, 20 years ago.
Yeah,
sure.
And additionally, Arina, from the perspective of investments as well, like I mentioned, loans for refinancing new equipment, new plants, for these similar industries, they would have to green them as well. So as a matter of fact, they would go greener, and then the challenge will be eased off. But if they, do not intend to green any of or reject any of the existing practices of plant and machinery, that would be also trouble for them to get investments for loans in future as well. So it works both ways, not just from an insurance practice perspective, but also from the financing perspective. Yeah, I know this is an insurance and Takaful conversation, but it's got to jive together, right? So everyone has got to work together to bring sustainability to the table, not just one side of the hand and not the other hand. Yeah.
Yep. As you can see, I think the discussions at the floor is going beyond just what insurance and Takaful is doing, but in the whole circular economy sector, what essentially is finance, sustainable finance means, and how do you rally that? Maybe I'll just close off with thoughts from both of you on TCFD, because essentially in Malaysia, TCFD is another angle that has been gaining much coverage and discussions, including the central bank has also provided the guidelines and recommendations to TCFD. But I think for those who have embarked and are midway through the task force on climate-related financial disclosures, they would also like to get your thoughts, Junior and Teresa, as they looked at the overarching areas within TCFD matrix and disclosures. For those who are starting off in their first I would say 3 to 5 years, what are the key, what would be your recommendation as to, the first few steps to actually make sure, they learn from Zurich as well? Where are the areas that, they could hasten that to get on board faster?
Would you like me to take that question? I think the perspective is you have to have a strategy first for sustainability, right? And then stemming from the sustainability strategy, iron out what your metrics are to achieve. Okay, then you can disclose. It's all very good saying in the air that I'm going to have less carbon footprint, I'm going to have less of this, and I'm going to do more of that. But if you do not have a strategy, you will not land there, right? So TCFD is very good in the sense that it pins us down to what we have to disclose as a responsible corporate citizen, and therefore we have to focus on the strategy. So two very key points: where is your strategy and what are your key metrics to achieve what you can then disclose financially as what you have supported for sustainability. So this task force has worked for many years to come to a place, a standing where, what would be deemed as good disclosure and not just greenwashing, right? So that's very important, even if for a starter right now. And I believe in the insurance industry, there are a number of public listed companies who have been on that path because of by virtue of SC's requirement to disclose. There are some companies who have already been disclosing. So for the others, this would be my advice. Yeah.
Maybe I'll get Junior's last thoughts is, while some are already advancing and Teresa talked about strategy being the core focus area, what do you think is the biggest challenge to, advance in terms of TCFD for those who have already started but looking to mature on that journey? Maybe the harder question is,
that is a tougher question, Arina. I was going to say time's up on that one. It's not an easy question to answer, right? For those that are starting, I applaud the companies that have started. The key is to start, and I would have to say that I think the industry can do more to have a much more deliberate approach, and it's not just about the strategy, but a genuine and authentic approach in terms of what they want to get out of sustainability. And I think that it's not just the insurers that play their part, because there are other people in that ecosystem for that circular process to work, right? So in light of that, I think the key is just to be more deliberate. It's hard for me to answer that just because I echo what Teresa's saying in terms of making sure that you know exactly what you want to get out of it. And it's not the initial strategy, but it's like, what is your long-term view and where is it that you want to go with this? And how do you measure yourself and how do you ensure that you do it, as opposed to just, because it's very easy just to fall into the lull of doing the same old, right? The key is how do you then elevate that and make bold commitments? If you look at about a lot of the companies out there globally, they make certainly massive, bold commitments that you look at and you go, how are they going to achieve this, right? But I think it forces you to hold yourself to a higher standard. So maybe not just about the strategy, or making sure that you push yourself to the limit to say there's no other option, and that's what you're going to do. And maybe that's one way to kind of elevate the game that everyone has to undertake. For those that started and for those that haven't started, is just to get it started.
Thank you, Junior. Yep, so we actually have come to the end of your session. I would just like to, say a thank you note to Teresa and Junior for a wonderful session. I will sum up the key takeaway points from your session today by, highlighting the core focus areas that both Teresa and Junior has highlighted, whereby there is a digital evolution occurring, and from this there must be certain connectivity to understand what the customer changing needs are, and how this is also centered around upskilling the key workforces, not just to handle what the customers' changing needs are, but to also consider the integration of the climate risk management and the overarching ESG impact. The other part is, I like your point on progress over perfection. And this is a long-term game because you want to be well aware and well positioned that your business is still in existence in the 2050 scenario, and how this is also being done in rallying and pushing your business partners towards taking the journey and elevating the impact as a collective ecosystem. Now, with that, I thank you, Junior and Teresa, for your time. We're going to take a 5-minute break and we will be back shortly. So thank you very much.
Thank you. Thanks.
Thank you. Thank you for your attention.
Welcome back, everyone. Our next speaker today is Marcel Omar Papp. Marcel is the Principal Officer of SwissRe Kuala Lumpur branch since August 2018, overseeing both the conventional and Takaful operations of SwissRe in Malaysia. Under his leadership, SwissRe Takaful has become a market leader in Southeast Asia and has won several Best Takaful Operation awards. Now, in his presentation to us today, Marcel is going to talk about climate risk and the other sustainability risks in underwriting and the main elements as well. He will discuss how to integrate sustainability issues into risk management, underwriting, and capital adequacy decision-making and relevant tools and data available to carry this out. Over to you, Marcel.
Assalamu alaikum. Good morning, good afternoon, ladies and gentlemen. Thank you for giving me the opportunity to present at this esteemed event. And thank you, Arina, for the kind introduction, and to all of you for attending this session. Could you please move to the next slide? Just imagine for a moment, it is now 2050 and you open your electronic newsletter. The headline you read is as follows. Next slide, please. Malaysia's GDP has reduced by 30% in the past 30 years due to climate change. Or phrasing it differently, without climate change, the Malaysian economy would have grown by 30% more in the last 30 years. You may ask yourself, why would such a headline be in the news in 2050? And more importantly, how realistic is such a statement? Next slide, please. The reason for coming up with such a statement is a recent research study of the SwissRe Institute looking at the economic effects of climate change. The main conclusion is that climate change is a very serious long-term threat to global economy, and effects are especially severe in Southeast Asia, including Malaysia. This is due to a combination of a hot and wet climate, important parts of countries being at sea level, and an unfavorable makeup of the economy. Sea level rise from climate change will affect Southeast Asia disproportionately. Hot weather will lead to more droughts, affecting agriculture, and also income from tourism will reduce. Furthermore, countries in this region may have less capabilities to adapt their economies. Based on the assumption that the existing temperature rise will continue on the same trajectory, temperatures could increase by 2 to 2.6 centigrade until 2050. In such a case, Malaysia could lose more than 30% in GDP by then. The reason for mentioning this research is that no action is not an option, and we have to do something now, also about the underwriting of sustainability risks. If you are interested in more details of this study, you can go to the public website of SwissRe where you can download the report. Next slide, please. After a short introduction on sustainability strategy, I will talk about the why, what and how of sustainability underwriting, and also give you some examples how sustainability underwriting can become a growth driver. Then I will give you some advice how to start your sustainability journey in underwriting before a short summary. In the end, we should have enough time for a Q&A session. Next slide, please. So let's start with the introduction. Next slide, please. You might ask yourself why someone from SwissRe is presenting on sustainability. The main reason is that SwissRe has a long tradition of sustainability. I do not want to go through all the points mentioned in this slide, just want to highlight a few key points. SwissRe has already started to consider sustainability more than 40 years ago. And in 2009, the company has come up with an ESG framework on how to write sustainability risks, which I will explain in more details later. Besides of a commitment to the Paris Agreement in 2015, SwissRe has also pledged to achieve a net zero greenhouse gas emissions in operations by 2030 and across the entire business by 2050. It is important to note that such commitments have also an effect on the approach to sustainability underwriting, which I will explain later. Next slide, please. It is very important to note that it is not possible to look at sustainability risks in isolation, but it is necessary to embed it in an overall sustainability strategy. Let me show you now how the elements of such a strategy could look like by presenting you with SwissRe's sustainability strategy as an example. Next slide, please. SwissRe's sustainability strategy consists of three main elements. At the core is the sustainability mission to tackle sustainability challenges and to create long-term value. By this, the sustainability mission is very closely linked to the group mission, which is to make the world more resilient and sustainable. At the next level, the company has come up with 3 sustainability ambitions until 2030, which is to mitigate climate risk, building societal resilience, and to advance energy transition and come up with digital solutions. Out of these ambitions, it has finally derived a few key principles. Most importantly, the sustainability is embedded in all our business activities. We are coming up with solutions to tackle transition risk and also quantify the impact of sustainability risks. Let's now move, next slide, please. How sustainability underwriting could look like, looking at the why, the what, and the how. Next slide, please. Let me start with why. Why are insurance and reinsurance companies starting to look at sustainability in underwriting? There are various reasons for it. First of all, there is increasing regulatory pressure. Regulators across the globe and also here in the region start to demand more from insurance companies. I think all of you are aware of the recent guideline by Bank Negara on climate change and principle-based taxonomy. And there are many similar regulations globally and also here in the region. Another reason is putting strategy into action. More and more insurers are committing to sustainability targets or make commitments. And in order to achieve these commitments, it's necessary to put actions up. Often they start with their own operations, but then they look also at investments and also underwriting. Another key reason to look at sustainability underwriting is the reputational risk for not doing so. Just writing one bad risk can be expensive for a company by having a negative impact on public perception or ultimately also on the share price. Just to give you a very recent example, just last Friday, it was mentioned in the local press, in various publications, that the global environmental movement has recently protested outside of Lloyd's in London, demanding Lloyd's and the global insurance and reinsurance companies to stop providing thermal coal cover. Another reason why you should look at sustainability risk underwriting is better improved risk selection, because underwriting some of the not so sustainable risk could have a negative impact on your overall portfolio. Last but not least, sustainability underwriting can also be a growth driver by offering new solutions, new products to cover the transition risks and the risks from renewable energy, and to help your clients to transition. So they can become also a growth driver for a company. Let's do now a polling question. Could you please start the poll? You can see here the polling question is, which reason is the most important for your organization to look at sustainability of underwriting? Thereby, I mentioned all 5 reasons which I have explained just in the previous slide. I know most likely there are various reasons why you look at this topic, but I would like you to just pick one, the most important one. So please feel free to give your vote. And are there already some first results available?
Okay, Marcel, we have
Yeah.
the results. Yep.
Okay. So as expected, actually, it's a mix. So all 5 have, as I can see, all 5 have received votes, and I'm glad to see that it's really putting strategy into action. So really, for me, it's a sign that organizations are really taking this as a serious topic and really want to do something about it. So I'm pleased to see that more than 1/3 put answer B as the first one. I'm also not surprised that almost 20% picked regulatory requirements, because that could be also a key driver. Let's move now to the next slide, please. So now let's look at the what. What do you do when you do sustainability underwriting? Risk management is really a key to ensure that the company does a controlled risk taking. Just take an example where you have a new business opportunity, which is a risk which might be very profitable from a business perspective, so economically beneficial, and it's perfectly legal to write this risk. However, writing this risk might have an adverse environmental impact. So it's important to recognize the existence of such problems, approach them ethically, and then address them responsibly. And how can you do that? There are in particular 3 aspects which need to be considered when managing the sustainability risk in underwriting. The first one is risk monitoring and escalation, to make sure you are aware if you write sensitive risk. And I will talk about this in more details later in the presentation. The second aspect is the identification of new emerging risks. The effects of climate change are evolving. Therefore, it is important to assess new risks arising out of it. Just to take an example, risks relating to the loss of nature, for example, biodiversity or deforestation, will eventually need to be considered by insurers in their underwriting and risk selection. The third aspect to keep an eye on is modeling and portfolio steering. Because climate change has an effect both on your existing and future portfolio. And this is important to take into consideration when you model the risk. For example, climate change will most likely lead to an increase in floods. So if you just do the assessment of your portfolio based on historical flood data, you might underestimate the impact because due to climate change, most likely sea levels will rise. And by this, your existing portfolio will be in future much more affected by floods. So this is a third aspect you need to consider. Let's now look at the how. Please move to the next slide. So looking at how to do the monitoring of sustainability, I would like to shortly explain to you SwissRe's ESG framework as an example. The aim of the framework is really to identify, mitigate, and potentially eliminate sustainability risks. It is important to note that it applies to the entire portfolio, to all the businesses underwritten by SwissRe, and it is fully embedded in our SwissRe standard operating procedures. The framework consists of two umbrella policies on human rights and environmental protection, several sector-specific guidelines, especially in areas which are sensitive from an ESG perspective, company and country exclusions, and the ESG process. It is very important to note, to highlight that this policy is not set in stone and is being constantly updated and revised based on new scientific evidence and so on. Next slide, please. Just quickly to explain to you how the referral process goes. So whenever a business practitioner gets a new offer from a client, she or he has to do a sustainability check on the transaction. For this, so-called assessment tool can be used, which highlights whether the risk is a low or medium risk, a high risk, or we should abstain from writing the risk. In case it's a medium or low risk, the practitioner can go on to write the risks. However, if it's a high risk, a referral has to be made to a team of ESG experts, which make then an analysis of the risk. Based on that, they come up with a decision, either for the practitioner to proceed with certain conditions, or to abstain from writing the risk. If the practitioner is not satisfied with the decision by the experts, he or she can always refer the risk to senior management. Let's move now to the next topic, and for this, my second polling question. Are sustainability considerations primarily slowing down your business or creating new business opportunities for your organization? Here again, you have naturally two options, slowing down the business or creating new opportunities. Please just pick one, even if you feel it applies to do so. Which one is the primary focus, slowing down or creating new opportunities? Please submit your choice. If you can share the polling results, that would be great.
Okay, Marcel is coming up.
Thank you.
So we have 63% that responded that is creating opportunities, and 14% says that is slowing down business.
Thank you, which is great to see, because because historically, and please move to the next slide. Sorry. Next slide, please. It's good to see that the majority sees it as a growth opportunity, because historically, building ESG or sustainability into underwriting has all been about exclusions, what not to underwrite. For example, as mentioned already, thermal coal or other sensitive risks. However, now, when we look at ESG into underwriting, we are seeing a shift in the industry from just looking at the exclusions to a combination of exclusion and inclusion. So also to see what the industry can do more and what the industry can do as an enabler, because sustainable business is good business in the long run. In case of SwissRe, we are evaluating all our portfolio against the 17 UN Sustainability Development Goals, and are identifying opportunities linked to them. And we do this every year, and as a result, we come up with new products, new solutions to support the transition. Next slide, please. Oh, yeah. Just to highlight a few products to address sustainability challenges. For example, protection against the lack of solar irradiation. This product kicks in if a solar panel doesn't produce enough energy due to a lack of sunshine because of bad weather, or the cover for offshore wind farms. On the life and health side, cover for low income groups and impaired lives, or on the agriculture side, the parametric products to protect farmers. Yes, so these are all products, just a small sample of products which can be developed and can become a growth driver for companies. Let's now move to the last polling question. Next slide, please. And this is about on which state is your organization in its sustainability journey in respect specifically of underwriting. As you can see, you have 5 options. To the very left is that you haven't started at all, haven't looked at it. On the other extreme is that sustainability is already fully embedded in your underwriting. In between, you have various other options that you have taken a few steps or you are already well advanced. So please, again, just pick one to see where you are in the sustainability journey based on your assessment. Please open the poll. Thanks. So thanks for the results. I see again a wide variation. Some companies are already actually already fully embedded, but I can also see a few which have actually 1/3, which has just taken a few first steps, and some have not even started in their journey yet. Moving to the next slide, please. So here I just would like to share with you a few thoughts what you should do dependent on naturally where you are in your sustainability journey in underwriting. First of all, an assessment of where you are at this moment of the status quo. How are you currently assessing the sustainability risk in underwriting? What processes and frameworks do you have already in place? The next step is really to what is the jobs to be done? What are the next focus areas? You have to decide on the next focus areas in the integration of ESG in underwriting. As you will not be able to do everything at once, you will have to decide on which areas to focus on. And this is really dependent, most likely to a degree, on your sustainability strategy and also your portfolio. The next question is what pain points, what challenges you are currently facing when thinking about the implementation of ESG in underwriting? What's the biggest question that remains for you regarding sustainability in underwriting for your company? And finally, what kind of support do you need? Who can support you and in which way? Moving to the next slide, please. In this respect, I just want to share with you a few publicly available guidelines and data sources you can use to come up with a framework or improve your framework in underwriting for ESG. All these guidelines and data sources also SwissRe is using. With this, I have actually come to the conclusion of my presentation. Let me share with you 3 key takeaways. Moving to the next slide. Next slide, please. First of all, no action is not an option anymore. Secondly, sustainability underwriting needs to be embedded in an overall sustainability strategy and cannot be done in isolation. And finally, sustainability underwriting is both a risk, about a risk like exclusions, but it's also an opportunity, can be a growth driver. With this, I have come to the end of my presentation. Thank you very much for listening. I think we have a bit of time for Q&A. So Arina, if I can hand back to you.
Yes, Marcel, I think that's a very critical and succinct sharing that you have done. And I think our floor of attendees today would benefit very much on the detailed sharing on the steps and considerations that you've outlined to actually drive the underwriting aspects on managing the climate risk. Now, maybe we'll quickly get into the Q&A session. So we have a question from the floor that talks about, looking at the Malaysia landscape, and we've seen as well various research that says that Malaysia and Indonesia have been ranked as countries which are most vulnerable to climate risk. Now, in your view, Marcel, what policies could government and regulators implement to increase our climate resilience in SwissRe's view?
Good question, thank you. I mean, as we all know, it's not, there is no silver bullet. So there would need to be a whole range of policies, and which has to entail the whole economy. As we have heard beforehand, the economy of both countries, Malaysia, Indonesia, is still very much dependent on thermal coal, oil and gas, palm oil. So there needs to be a move to renewable energy, but this is something which not the government by its own can do. It needs the effort of all parties. I mean, I have to say the government in Malaysia has very ambitious targets. It's really now all about the implementation. And as a speaker in the morning has said, it's also about like creating the awareness also. I think it's still not always there in the public, also consumers. So everybody can do steps. So I think the government and also Bank Negara is on the right track, but all the parties have to play their role, otherwise it won't work.
Thank you, Marcel. Following up on that as well, there is also a question, that deep dives further into a specific area in life and health underwriting. I think the question then is for those who wants to embed sustainability in underwriting for life and health insurance, what are the quick wins to kickstart the process?
I think as we all know, there is still a huge protection gap, especially amongst the low-income population. Also here in Malaysia, it's several billion US dollars. So for the life insurance and Takaful industry, it's really important to come up with products for this segment to also give them some kind of cover. And I'm happy to say the industry is taking steps. The Takaful industry has the Perlindungan Tenang scheme. So there are steps taken, but more has to be done. The aim is really to provide cover to also the B40, more cover, because there's a huge protection gap there.
Thank you, Marcel. And looking into the research report that, I actually did had a look at the SwissRe report, and it's very comprehensive, and it provides quite a vast coverage, not just on context of what the technological and natural environment contexts are. It also talks about, how it is a competitive business environment. Now, maybe riding on, competitive business environment, there is a question from the floor that wants to know, what are, in your view, how can this also drive the triple bottom line direction? For example, if we look at not just, having solutions being addressed by certain underwriting, how would this then also sustain the business, or at least shift towards economic growth for the insurance industry?
I think in the insurance and Takaful industry can play a key role in the transition of the economy to a more green economy and help companies. It's not about not writing brown risks, for example. It's really to help companies in their transition journey, corporations, and really also to nudge these companies to do something about sustainability, as already highlighted by Junior and Teresa in the previous presentation. It's about working with your partners and helping them in their transition, and hopefully this will then also grow your own business, because it's not about not writing risk, but working together with your partners.
So thank you, Marcel. There's also a question, like, do you already see reinsurance rates factoring in sustainability? And is there a difference between how much is reflected for non-life versus life and health?
I would say it's at this moment not necessarily a direct impact on rates. It's because you more look at whether you want to write a certain company or not, because and therefore I think we're not yet at the stage where we would increase the rates for certain risks, but rather impose some terms and conditions, some targets for the company to achieve from an environmental perspective. Because to be fair, it's not so easy yet to quantify the impact, to be fair. I mean, data, and I think this has been mentioned, is not so easily available. And it cannot always be just because of climate change. For example, floods are increasing simply because of climate change. There are other reasons for it. So I think the industry is not yet at this stage where they can really put a quantification so easily.
I understand that, Marcel, from what you have just shared. The challenges is that now maybe I will give it a different twist. Now that you've covered the various key actors that needs to come into play when driving advancement in how the ecosystem can then coordinate itself to actually rally a more effective way to actually communicate where are the pain points, where are the gaps in underwriting, where are the gaps in the opportunities that can be tapped on, what are the emerging technologies that also require insurance funding. Now, what would be your advice to the insurance community, insurance and Takaful community in Malaysia, in that sense of how do they then coordinate themselves effectively, to actually at least address the more quick wins to actually rally this?
I think the insurance and Takaful industry cannot do it on its own. It has to work together with the other actors, with the other financial institutions and also the government. So we have to identify which are the key areas where maybe banks do not want to take on certain risks. For example, if they do the financing, and here the insurance Takaful industry can come in and take over part of the risks. Now that's specific on underwriting. Naturally, on the investment side, that's up to invest more in green sukuk bonds and so on. But I think on the underwriting side, it's really to find the areas where there are new projects, for example, and banks might be hesitant or other financial institutions to support them because there are inherent risks involved in such projects. And here maybe the insurance industry can step in and take over some of the risk by offering new products, such as the solar irradiation, which I mentioned to you. And there are many other products available.
Thanks, Marcel. Now, one more question is, how would reinsurers and Takaful play the kind of role to support operations in developing products with sustainability ideals? So the question then is, there are perceptions at this point that it may not be profitable until it reaches a certain level of scale. Is that a myth, or is it something that SwissRe feels that this myth has been long gone, or it is still in that journey to be defined?
I have to admit that this type of products are still a niche for Malaysia at this moment. So I don't think there are huge profits to be made at this stage. But we have all heard from during this conference that efforts will be accelerating. So, and I think it's now time to go in to offer products, even if in the beginning profits might not be so good, so great. But I think over time, without question, it will be also in Malaysia a big growth area. And we see this in other markets. Just to mention, for example, China, where there is already a huge demand, and other countries as well. So I think Malaysia, it will come. It just takes maybe a bit longer. And I believe it's now time to act and not just to wait.
So we come to the last questions, which may be more from your viewpoint as well, having the overarching, a more global view in this. So from the observation of the Malaysia regulatory environment, is it feasible to actually encourage product innovation to ensure environmental risks, in your viewpoint, as compared to the perhaps other legislation that you've observed?
I think it's a good question, and it's great that Bank Negara has taken the step. And really, I've seen now in client interactions much more interest in this topic compared to even a year ago or 5 years ago. It was not a topic. I don't think it should be only regulatory driven. Naturally, that is one incentive for companies to do something, but it should not be based on regulation only. Companies really should see it as an opportunity and not only a regulatory requirement. And we also need to be mindful that not to overstep with regulations. If regulations become maybe too prescriptive, sorry, then it might even hinder the growth. So you need to find also the right balance. It should encourage companies, but it should not hinder them. So I hope the development will not only be dependent on new regulations by Bank Negara.
I fully agree with you, Marcel, where, that it could be counterproductive to have too much prescription, where it can actually hinder what can be done. And I really like your slide where, you have the insurance as an enabler, where you have the exclusion, but also we have seen from today's polling that more than 60% are saying that there are more potential in going towards the inclusion. And I really like the point that you mentioned about underwriting portfolio, considering the UN SDG goals, focusing as well on what the products are aimed to address in terms of sustainability challenges. So these are really, again, centering back to, it's not just pushing products to the market, but essentially it's understanding what the gaps are. And you rightfully mentioned that the coverage of the insurance gaps is still very wide. There are still quite a number of potential to be managed. Of course, the margin discussions will mature over time as this mature. So I'm just going to sum up a few key points I really value from your presentation today, Marcel, where you talked about, processes are not cast in stone upon rollout. I think that's very critical for those who are actually putting up a framework or detailed processes. Then there's a clear recognition that it is a continuous enhancement. And from what you have shared now, that SwissRe has already put in place at least an ongoing process to review and especially to have the referral by experts to come in and actually work together to right the risk and proceed, whether do you proceed cautiously with conditions or you need certain deliberations. There is a recognition that further thoughts, the innovation needs to come in with further thoughts, discussions, and wider collaboration. I truly appreciate, what you have shared, Marcel, and I think with that, we can safely conclude your session, but I know you're staying to wrap this up for us as well, so thank you, Marcel. I will now, yeah, thank you, Marcel. We really appreciate your sharing session. All right, so for the next session, we have also would like to invite our distinguished next panel speaker, Elmie Aman Najas, who please welcome him. And today, Elmie is currently the chairman of the Malaysian Takaful Association, MTA. He is also the CEO of AIA Public Takaful Berhad, where his key responsibility is to develop the family Takaful business, drive product innovation, and increase Takaful penetration rate in the Bumi segment by leveraging on AIA and public banks' leadership positions, and established, he has also established quite a number of infrastructure and distribution networks. So Elmie today will help us to understand why sustainability is critical in Takaful, what is VBI, value-based intermediation for Takaful, VBI Takaful, what it means in terms of, being implemented, and how VBI Takaful is able to address sustainability in Takaful. Elmie will also share and explore what are the practical challenges faced and how this can be potentially addressed. So over to you, Elmie.
Thank you very much. Before I begin, perhaps we could play the video that we had during the launch. Thank you. Assalamualaikum warahmatullahi wabarakatuh, and a very good day to everyone logged in for today's session. Thank you, Arina, for the kind introduction. I would like to thank Bank Negara Malaysia, the Joint Committee on Climate Change, JC3, and the organizer for the opportunity given to the Malaysian Takaful Association to introduce the value-based intermediation for Takaful, or VBIT. It is indeed an auspicious day for the Malaysian Takaful industry to be able to present ourselves globally with the agenda that will be important for the ongoing development of Takaful, and that is sustainability. Next slide, please. In today's presentation, I will touch on four main areas, which are why sustainability is critical in Takaful, what is value-based intermediation for Takaful, and how VBI for Takaful is able to address sustainability in Takaful. Lastly, I will also share with you on what are the practical challenges faced and how this can be addressed. Next slide, please. Ladies and gentlemen, let me start first by giving a brief background of Takaful in Malaysia. Takaful has been in Malaysia for the past 37 years. Since 1984, the Malaysian Takaful industry has constantly worked to empower society and businesses by providing a variety of Sharia-compliant products and services to support the objective of improving the financial resilience of Malaysians. At the same time, Takaful industry has progressed through many regulation changes throughout the years. In 1984, the Takaful Act was enacted to govern the conduct of Takaful business in Malaysia. 4 years later, in 1988, Bank Negara Malaysia took over the supervision of the insurance and Takaful industry from the Ministry of Finance. In 1995, the ASEAN Takaful Group was established, and this marks the establishment of international collaboration for Takaful in the region. The objective of its establishment is to enhance mutual cooperation and foster connection amongst Takaful operators internationally. In 2001, the Financial Sector Master Plan was launched by Bank Negara Malaysia, a 10-year plan that aspired to develop a more resilient, competitive, and dynamic financial system with best practices, one that supports and contributes positively to the growth of the economy throughout the economic cycle. The master plan outlined the Islamic banking and Takaful roadmap, which strategically positioned the industry's next stage of development and expand its significance in the Malaysian financial landscape. This period saw the introduction of new Takaful operators, which included multinationals. At that time, the market shares for Islamic banking and for Takaful were at 6.9% and 2% respectively. Clearly, there was vast potential which was yet to be tapped for Islamic finance. Later in 2011, Bank Negara Malaysia unveiled the next financial sector blueprint theme, Strengthening Our Future. The blueprint charted the future direction of the financial system over the next 10 years. There were several focus areas under the blueprint which further advanced the financial sector to drive Malaysia's transition to a high value-added and high-income economy with adequate safeguards to preserve financial stability. Among the focus areas were the effective intermediation for a high value-added and high-income economy, the financial inclusion for greater shared prosperity, and empowering customers. At this time, the market shares for Islamic banking and for Takaful grew to 22.4% and 8.8% respectively. Additionally, new Takaful operators were also granted license during this period to help push the growth of Takaful and deeper penetration. Next slide, please. Over the next 10 years, there was rapid progress in terms of the introduction of various regulatory guidelines, such as the introduction of the Sharia Governance Framework in 2011, the Takaful Operational Framework in 2012, the introduction of Islamic Financial Services Act, IFSA, in 2013 to replace the earlier Takaful Act, and the risk-based capital framework in 2014. There was also the phased liberalization of motor and fire tariffs in 2015, and the introduction of the life insurance and family Takaful framework in 2016, which helped push further liberalization and promoted market competition to deliver better proposition and value to customers. Together with the revision of the Takaful operational framework in 2019, this marked the period where the Takaful industry started to respond to the regulatory calls for the Takaful industry to reform itself in order to remain competitive, to stay relevant, and to future-proof the industry. By 2020, the market shares for Islamic banking and for Takaful were at 34.2% and 11.8% respectively. Ladies and gentlemen, there are three key features of Takaful that are inherent to the industry, namely Syariah compliant, mutual benefit sharing between participants, and transparency. And these are the fundamentals that make up the industry's unique value proposition to the consumer. For the past 10 years, the compound annual growth rate for Takaful was at a steady average of 11%. This was driven by the increasing demand for Sharia compliant solutions. However, the progress of Takaful in terms of market share lags behind Islamic banking. There is growing concern that the growth masks deeper issue of whether Takaful is able to sustainably continue on its growth trajectory and deliver its true potential in future years if it does not address the barrier that impedes its future growth. Next slide, please. Ladies and gentlemen, after 37 years, there still remains persistent barriers to Takaful growth. The Takaful penetration, which is a measure of the number of family Takaful enforced certificates to the total Malaysian population, is still low at only 16.9% in year 2020. This is despite the Muslim population, which is a natural market for Takaful, constituting 60% of Malaysians. Over a decade, the industry penetration has only grown by about 5.7%. If it is expected that the pool or draw of consumers to participate in Takaful is because of Sharia compliant reason, and that this is enough to deliver strong growth, then the results do not support this. This points to other reasons for why the low penetration rate continue to persist for Takaful. The low penetration rate leads to the issue of Takaful unable yet to achieve the critical mass that is required to ensure its financial sustainability. Although we have seen the growth of assets for Takaful industry growing, the value of assets for conventional insurance are far higher. In 2020, Takaful asset size account for only 13.6% from the total insurance and Takaful's asset. The industry players have yet to show significant value creation to the stakeholders at large. And this creates a vicious cycle where additional capital which is needed for more growth hard to come by. A question of which comes first, the chicken or the egg, that is, growth or additional capital. There are still unserved and underserved market segments that are not covered under Takaful. For example, many products in the market are focusing on savings and investment elements that are complex, sometimes difficult to understand and unaffordable. Such products are usually designed for mass affluent segments and are generally not well understood by consumers from the lower income groups. The lack of Takaful products for B40 households is an example of market failure to provide protection for the underserved segments. There is a mismatch between the Takaful products and the needs of the intended segments. There is also a low awareness on the need and importance of protection. Across all segments, there are still many people who do not consider Takaful as an important tool in their financial planning because of the low perceived value of Takaful products. This creates a challenge in the lack of interest from the public to participate in Takaful. What is also concerning is the low financial literacy among the public, which hinders them from understanding Takaful and its importance. Based on the data published by the Employees Provident Fund, Malaysia's existing social protection system provides benefits for only 38% of working Malaysians, with the rest, approximately 13.7 million people, excluded from such protection. They reported that 68% of active members do not achieve the target basic savings, and 70% of active members above the age of 54 have less than 50,000 ringgit, which is grossly insufficient for retirement saving. Now, it is here in the solutioning of Takaful products that the industry have been unable to leverage on Takaful's unique value proposition to have more people to participate in Takaful. It is therefore clear that in order for Takaful to achieve the next phase of growth, a new approach is required to make Takaful more appealing and drive greater connection with the man on the street and businesses. This is where there is an opportunity for the Takaful industry to change and reimagine itself anew and create a better value proposition. This higher value proposition for Takaful leverages on going back to the true essence of Islamic finance, which is the realization of the Maqasid Sharia or the intended outcomes of Sharia. Next slide, please. Ladies and gentlemen, today I would like to set the tone that sustainability is critical for Takaful. Islamic finance, of which Takaful is a part of, is developed with a higher overarching view objective of Maqasid Sharia that emphasizes the attainment of positive value creation and the prevention of negative impact. Takaful core values are driven by Maqasid Sharia. As an extension of Islamic economics, Takaful seeks to balance social responsibility with the aspiration of sustainable prosperity. Takaful, the sustainability concepts that emphasizes on the environment, society, and governance, that is ESG perspective, as well as people, planet, and prosperity, or more commonly known as the three P's of sustainability, are very much in tandem with Maqasid Sharia. Therefore, by embracing and highlighting sustainability, we are embracing Maqasid Sharia, and this will further strengthen the unique value proposition of Takaful. By embracing Maqasid, which is in line with ESG, Takaful will be able to deliver greater impact to the society and the planet. This will enable for Takaful to better connect with the society and hence creating greater appeal to push Takaful beyond the current penetration limits. And this will help to elevate Takaful's unique value proposition and help it achieve the critical mass that the industry requires for its own sustainability into the future. Embracing Maqasid Sharia is about embracing sustainability. This means the future focus is to go beyond just Sharia compliant, to transform the Takaful industry towards achieving the ultimate objectives of Sharia. In summary, sustainability is critical to Takaful as it is part of Maqasid Sharia. By embracing sustainability, Takaful is going beyond just Sharia compliant, and this will further strengthen its value proposition and connect better with the society. Next slide, please. Ladies and gentlemen, what is value-based intermediation for Takaful, or VBIT? The term VBI is not new, for it has been introduced by Bank Negara Malaysia a few years back. Since the issuance of Bank Negara Malaysia's VBI strategy paper for the Islamic financial institutions in 2017, the Takaful industry is committed to enhance its sustainable business practices and values with the customer and other stakeholders in mind. The VBI strategy paper focuses on the adoption of practices that generate sustainable impact to the economy, community, and environment, or ECE, which are universally applicable within the financial sector community. It is consistent with other sustainability concepts, shareholders' sustainable returns, and long-term interests. The Islamic banking industry has started the ball rolling by implementing VBI. The introduction of VBIT framework is a big step taken by the Takaful industry in adopting VBI. The framework is comprehensive and is relevant to family Takaful, general Takaful, and re-Takaful operators. VBIT reflects the industry's aspirations to elevate Takaful to the next level by transforming the industry towards achieving meaningful sustainable growth, whilst delivering impactful and measurable values to the customer and stakeholders. It is a framework to guide the industry in the implementation of value-driven and value-based agenda. The objective is to deliver positive socio-economic impact while sustaining positive financial returns for the relevant stakeholders. While VBIT shares similarities with concepts such as ethical finance, ESG, and sustainable and responsible investment, that is SLRI, the distinguishing feature is the central position of Maqasid Sharia in determining Takaful's underlying values, moral compass, and priorities. What makes VBIT framework unique is taking the sustainability agenda and applying it through the lens of Maqasid Sharia. It emphasizes on achieving Maqasid Sharia in the implementation of the value-driven agenda, which aims to deliver positive impact while sustaining positive financial returns. As mentioned previously, the term Maqasid Sharia itself means the objectives and goals underlying the principles of Islam. In a broader sense, Maqasid Sharia covers the accomplishment of well-being and the avoidance of harm. In fact, VBIT complements very well the existing sustainability agenda since it is fully aligned to the United Nations 17 SDGs, ESG, and principles of sustainable insurance. The VBIT framework provides a guide for Takaful practitioners on the awareness of and the process to elevate the Takaful industry into an intentional and meaningful journey towards achieving the ultimate objectives of Sharia. This is the first of such a framework in the global Takaful landscape where it explicitly mentions Maqasid Sharia and sustainability in one line together. Next slide, please. The slide highlights the building blocks of VBIT framework, and you can read it from the left to the right. The framework can be coined as a step-by-step guide for Takaful operators to implement VBIT. The framework encourages the industry players towards realizing the objectives of Sharia or Maqasid Sharia, and further elaborates on the underpinning thrust of VBIT, which are financial resilience, community empowerment, good self-governance, and best conduct. The four underpinning thrusts acts as a compass for Takaful's journey in implementing VBI for Takaful. It is important that Takaful operators can consistently validate everything they do against the underpinning thrust of VBIT by asking the following questions. Will this help people become financially resilient? Will this empower the community? Are we practicing good governance? And are we applying best conduct? It is important for Takaful operators to be able to embody the trust even before setting the corporate value intent or CVI. The underpinning trust will guide Takaful operators to articulate the CVI, which is an expression of the Takaful operators' institutional intent or commitment. The CVI is more than just a statement. It is an organizational commitment and reflects the purpose of the entire organization at all levels, from the top to the lowest levels. That is the board of directors to the Sharia committee, the management, and down to the staff and intermediaries. The aspiration is that the corporate value intent or CVIs will create a more purpose-led Takaful industry that is able to resonate more with the society and the various communities. The CVI is then followed by the formulation of the key implementation strategies, which are inclusive stakeholder engagement, value-driven solutions, impact-based assessment, and constructive collaboration. These four key implementation strategies are interlinked areas and will ensure a holistic execution of the Takaful operators' VBIT actions. To ensure that Takaful operators are able to deliver the intended outcomes of their CVI, it is important for Takaful operators to put in place a comprehensive measurement of their VBIT KPIs to measure and assess their progress. The KPIs measures both financial and non-financial indicators under the 4 underpinning trusts of VBIT. For all the achievements and progress that Takaful operators would make in their VBIT journey, there is a need to communicate this to the various stakeholders. Therefore, part of the VBIT framework speaks about the need for impact-based disclosures to be made. This will help communicate the enhanced value proposition of the Takaful operators and create the favorable impression that is required to make Takaful more appealing. Ultimately, through VBIT, the industry will be able to deliver value creation for Takaful operators, government and regulators, and the society. This will create and shape a new future landscape for the Takaful industry. Next slide, please. Ladies and gentlemen, VBIT can address sustainability in many ways. To elaborate further, VBIT implementation involves a structured approach to systematically integrate the 4 underpinning trusts of VBIT into the existing Takaful's operations. Here, the Takaful operator's corporate value intent, CVI, is very important. CVI extends beyond the company's slogan. It acts as a voice for the aspiration of the Takaful operator's leadership. It expresses the specific desirable future that the Takaful operator is committed to achieving, a goal which balances the creation of value for all stakeholders. It is important to establish the CVI and understand how value-driven business strategies and practices can be embodied in the respective company's vision and mission. CVI integrates VBIT key underpinning trusts and is aligned with Maqasid Sharia and sustainability practical concepts such as ESG. Whilst there are many strategies to implement value-based practices and initiatives, these are the 4 focus areas highlighted in the framework to execute VBIT. 1. Inclusive stakeholder engagement in Takaful operators' strategic initiatives and action plans to ensure buy-in and support, as well as decision-making process. 2. Development of value-driven solutions to deliver meaningful value to the targeted segments. 3. Integrating impact-based assessment in VBIT initiatives to ensure a balanced implementation. And 4. Constructive collaboration with wide range of partners to create greater positive impact. The 4 implementation strategies are interlinked and overlapping in the sense that they can be implemented concurrently in one VBIT initiative. For example, when developing a value-driven initiative, a Takaful operator should consider engaging the relevant stakeholders such as with the NGOs, the local communities, and the relevant government agencies to understand better the customer needs and how best Takaful operator through its value-driven solutions can contribute to address any social and environmental issues. Next slide, please. When embarking on the VBIT journey, the Comprehensive Measurement or Comprehensive Key Performance Index, KPI, assesses the progress and effectiveness of the VBIT initiatives implemented by Takaful operators. If measured well, the KPIs will reflect accurately the progress and effectiveness of the Takaful operators' VBIT initiatives to achieve the intended outcomes. The measurements address both financial and non-financial indicators under the 4 underpinning trusts of VBIT, which are financial resilience, community empowerment, good self-governance, and best conduct. It is important to understand the KPIs thoroughly as they will guide Takaful operators in identifying whether they are progressing in line with their respective CVI. KPIs that also focuses on the non-financial aspects can shape positive and proactive behavior among industry players. A competitive environment will encourage industry players to strive in creating positive and sustainable impacts for their respective stakeholders. and this will create a balanced motivation to achieve short-term and long-term outcomes. Last but not least, it is also necessary to have impact-based disclosure. It demonstrates Takaful operators' accountability in implementing VBIT initiatives and discloses the Takaful operators' commitment in delivering sustainability values. It also reflects the progress and effectiveness of the Takaful operators' VBIT initiatives. The criteria for disclosure items include consistency, reliability, comparability, and meaningfulness. By publicly sharing their KPIs, Takaful operators may enhance the understanding of stakeholders of the role of the Takaful industry. Takaful value propositions become more attractive to all stakeholders with enhanced levels of transparency that disclose both financial and non-financial aspects of the VBIT initiatives. This encourages TOs to be more disciplined in implementing VBIT initiatives and to create sustainable impacts for their stakeholders, while upholding their respective commitments to VBIT. The scope, context, level of detail, and frequency of the disclosures can be appropriately tailored to the needs of the different groups of users of the disclosures. In summary, when an initiative is declared as part of the VBIT agenda, it needs to be validated against the underpinning thrust of VBIT, which are financial resilience, community empowerment, good self-governance, and best conduct. TOs and RTOs must then ensure that the initiatives implemented are comprehensively measured against the intended outcomes, with appropriate disclosures shared with all relevant stakeholders. Through the implementation of the various building blocks in VBIT framework, the ESG and sustainability agenda can be effectively delivered by the Takaful industry. Next slide, please. Implementing the VBIT agenda is not an easy task, but it is not impossible. Being able to identify the challenges and address them carefully will help Takaful operators and relevant stakeholders to work together to achieve the intended outcomes of VBIT. Sustainability is by and large intangible to some extent, and it is important to be realistic in balancing the financial requirements. That is, the resources needed and the perceived returns to the stakeholders, the uncertainty of getting returns from the investment on ESG, and how this will actually benefit the business and consumer. Nonetheless, business can use and view VBIT and ESG as a tool to reshape their business model. The sustainability agenda embedded in every decision will further strengthen the unique value proposition of Takaful. Capital is an important factor and crucial to run a business, especially if we are embarking on new agenda. Currently, Takaful operators have yet to achieve sufficient size, and this presents a challenge for Takaful operators to allocate sufficient resources to be committed to VBIT. However, Takaful operators should view VBIT as a long-term investment strategy to create new market opportunities. Government and regulator support can also play a role to support VBIT, such as lower capital charges and other incentives for VBIT initiatives, including products, services, etc. Subject matter expert and in-depth understanding of sustainability are needed to ensure effective implementation of VBIT. Hence, the lack of expertise, inadequate subject matter experts, and sufficient understanding in VBIT and related domains such as ESG, UNSDG, PSI, etc. should be addressed holistically. Partial understanding of these subjects may not be beneficial to the implementation of VBIT. The industry can collaborate on capacity building internally within the industry amongst Takaful operators and externally with NGOs, learning institutions, regulators, government agencies, sustainability leaders, and subject matter experts to develop the knowledge and resources of the board, SwissRe committee, senior management, staff, and intermediaries across all levels. Building higher trust and increasing the awareness of Takaful with the public is also a fundamental issue that needs to be addressed to ensure the success of VBIT. Takaful operators need to be more purpose-driven and develop more value-based solutions that can connect and reverberate with the needs of the community and the environment. The industry can come together to collaborate on initiatives to overcome the current financial literacy of lower and underserved segments, and also to reach out to specific market segments that are unable to get coverage due to high loading or require specific underwriting. For example, the disabled community or patients that suffer chronic diseases such as diabetic patients. Takaful operators can collaborate with government agencies and NGOs that have access, reach, and better engagement with the B40 and other unserved or underserved segments. This leads to the next point, that is stakeholders engagement and effective communication of what the industry aspires to do to become. There is a need to ensure that there is effective stakeholder engagement to communicate the industry's aspiration and what the industry aims to achieve with the adoption of VBIT. Strategic collaboration and effective engagement with various stakeholders can help to address the intended outcome of ESG and assist in determining respective Takaful operators' suitable strategic initiatives. This will result in better alignment towards achieving the VBIT goals more effectively. And lastly, developing comprehensive KPIs to determine and measure the right outcomes that are value-based, that can create value to the community or people, environment that is a planet, and economy that is prosperity. With the comprehensive KPIs that make sense and quantifiable, it enables the businesses to connect well with the community in providing insights on the VBIT progress and consolidating feedbacks for future improvements. Takaful operators may also consider to establish a VBIT advisory board consisting of advisors and experts from outside of the industry to discuss the possibilities and develop meaningful KPIs. Next slide, please. Ladies and gentlemen, in closing, the implementation of VBI for Takaful is a journey. It is necessary for the industry to undertake this journey to take the industry to the next level, where Takaful is able to resonate better with the expectations of the society and deliver positive and sustainable impact to the people and the environment, whilst at the same time ensuring the industry's growth and positive financial returns well into the future. This is the why and the what. The VBIT framework provides a guide to this journey and articulates the how VBIT should be implemented for the industry to achieve its transformational purpose. It is also about changing our mindset to spur creativity and encourage innovation to deliver positive and meaningful impacts. It will be the responsibility of Takaful players and all stakeholders involved in the value creation journey to achieve the Takaful industry's aspiration. By understanding what is important to the community, the environment, and economy, and continuously addressing the challenges holistically, it is hoped that over time, the adoption of VBI agenda will have a significant impact on Takaful companies' model and thus will drive the industry towards sustainable finance ecosystem. I would like to thank the various parties who have come together to collaborate and develop the VBIT framework for the Takaful industry. Firstly, the members of the VBIT task force comprising of representatives from the various Takaful operators in Malaysia. They were the architects of this framework. Thank you to the management committee of MTA, the MTA secretariat, and the CEOs of all Takaful and Takaful operators in Malaysia for their strong support for the framework. Thank you also to Jabatan Perbankan Islam dan Takaful Bank Negara Malaysia for their valuable guidance throughout the development of this framework. Also to the Islamic Bank's VBI community of practitioners for sharing their valuable experience, and to INCF for their valuable collaboration at the start of the project. I've reached the end of my presentation. Thank you very much for your attention. I hope you have found this informative and useful. You can download a copy of the VBIT framework using the QR code provided here on this slide for more in-depth information about the framework and some practical examples or case studies. Or you can also access the VBIT website at www.vbitakaful.com. Now, if you have any questions, you can also post in the chat, or you can email us at mtasecretariat@malaysiantakaful.com.my. Back to you, Arina.
Thank you, Elmie. That is a very targeted and in-depth discussion on the VBIT, as well as the significant efforts that has been put in place to bring the Takaful business to the current advancement that we have seen right now. We do have quite a number of questions, so maybe I'll quickly get into the discussion with you. So the first part, I think the participants from fall that wants to actually get more insights is looking at the VBI. How can it help Takaful operators to actually balance between providing the inclusive protection for the purposes of social reliance and business sustainability? So essentially, it's also talking about how do you balance that kind of consideration? Maybe your thoughts on this.
Yeah, thank you for that. So this is about balancing between what is good for the business and what is good for the people. And VBIT looks this from the lens of Maqasid Sharia, in terms that coming back to the principles of Maqasid, which is to actually provide benefits and positive outcomes to the people. And by doing so, we are actually making Takaful much more appealing to a lot more people, which will address the issue of awareness. And with further awareness, with people understanding better the value proposition of Takaful, it will actually have a positive impact to the business itself, because this leads to more business.
That leads us to the question as well, the next one, where they wanted to understand is, when we say, not just about what the market is able to, grow and offer, there is also a consideration of potentially, what are the dependency and potential asks. I know you mentioned about it earlier, that it could be a potential collaboration with incentivized strategic focus areas by the regulators or the government. So coming to this in terms of, looking at potential government subsidy for example, premium for the B40 protection, would that then be, avenues to make it more affordable or appealing to this targeted segment?
Yes, that is certainly a step in the right direction. But specifically in addressing the needs of the underserved, I think there's an opportunity to collaborate with certain government bodies or semi-government bodies which have a deep reach into the B40 segment. For example, Mara, for instance, or Tabung Haji, and these are organizations which have a very high level of trust within that community. So there is that opportunity to work. The industry can collaborate to work together with such institutions, so that we are able to then reach deeper into that market segment.
I think that's very helpful, Elmie. But the question then is, for ESG partners that are non-Muslim versus, for Takaful operators, how can they bridge the gap to, achieve a more seamless participation or support?
When we look at the values of Takaful, it is actually universal, right? I spoke about Maqasid. There's more deeper information about Maqasid in the framework document itself, and audience can look at it. But the values over there are actually universal, and it applies to everyone. So therefore, doesn't matter whether or not you're Muslim or non-Muslim, there are opportunities to collaborate together with the industry in order for us to deliver the intended outcomes that we want, specifically on ESG.
That's a very clear directive, because I think to a certain extent, the Sharia principles or the Maqasid principles are actually applicable regardless of religion and race, and they can actually have a look at that. I think this is actually clear the presumption that, there are still some presumption that, this is actually very much, not inclusive, but I think you have helped to actually clarify that as well over and time again. Now, the question then is, what are the plans of MTA to also consider incorporating TCFD indicators with the VBI initiatives? So I guess it gets more towards guidelines and framework alignments, which I think also will take us to the discussion of how do they ensure that, by adopting the VBI initiatives, they are also essentially also addressing TCFD.
Yeah. So, I want to share that at the industry, in the association, and the association comprises of all Takaful and Re-Takaful operators in the country. We have actually formed the VBIT steering committee, which part of the role is to look also at the roadmap for the industry. And the challenge, I think, in developing such a roadmap is that how does it take into account the different stages and development of the various individual Takaful operators and Re-Takaful operators, right? But through the VBIT steering committee, one of the aim is when we develop that roadmap is to also look at what we can do collectively together to set certain targets and milestones, and it will also include the commitment that we have on reporting as well.
I think that's very helpful, and I think we chat about the efforts of the steering committee previously, and it's actually very, very encouraging to know that one of the directive of the steering committee is to leave no one behind, and that's where there are a comprehensive coverage of the key players in the sector as well. So I think that's very encouraging to actually see that the sector is coming together in one steering committee to drive this. Now, then the question is,
So we were very mindful that when we developed the framework and when we formed the steering committee, the objective is to be inclusive. The association has got players coming in from the family Takaful, general Takaful, Re-Takaful operators. So obviously there's a lot of variety there. And we wanted to ensure that we are inclusive in our strategy so that, as you said, we leave no one behind.
Maybe I'll take that to a different level when it comes to your where you wear a different hat for AIA Takaful. I think the question is then, would you be able to share how would AIA Takaful go about implementing and integrating VBI into its strategies, daily business decisions, and processes? So it's more of understanding, in your role and capacity, how is that being driven internally?
Yeah, so we've taken the step of actually forming within our company itself a VBIT steering committee, and the objective is to help steer, the implementation of VBIT in a more structured manner. So that's something that we've started, and it will actually cover the range of all the things that we need to do, from the strategy right down to the implementation and execution as well.
Thanks very much. I guess the other question is, it gets more to the product level. You can see that the questions are getting down to the granular detail. So the question then is, in your view, what would be an ideal Takaful coverage best targeted for the underserved segment?
I think that in terms of the coverages for that particular segment, now obviously we need to understand the needs of it, right? And it is very easy to just say that the product or solution needs to be very simple, right? Because we need to break it down to such a level that it is easily understandable by that intended segment. Now, we are not taking that for granted, and what the industry has done together with LIAM, which is the Life Insurance Association of Malaysia, is to actually commission a B40 study to understand better about the needs of that market segment. And here we will be looking at collecting insights and data so that in the solutioning of the product, it is something that is really relevant and something that they really want. So I think that is a big step the industry is taking, and hopefully the B40 study is actually in flight now, and hopefully once that study is out, it will give the industry a better view in terms of what is the exact solutioning that is needed for that a particular market segment, especially because it comes from the study itself would actually reach out to that segment to ask them what are the things that they want to see in a product.
Thanks, Elmie. There is actually a question. Will VBIT and VBI converge?
I think that there is already a strong alignment between the two. VBIT itself takes inspiration from VBI, and naturally there is always this strong working relationship between the Islamic banks and the Takaful companies. So I think that I think that there is a lot of possibility for the two, and so I think in the future it's very exciting because this will see stronger collaboration that is going to be seen between the Takaful industry and the Islamic banks as well.
Thanks for that. And I think just to sum up, what you have shared so much, right? There are still quite a lot of potential to actually chart out the market growth as well as a fit for purpose ecosystem for the Takaful based on what you have shared, right? Perhaps the last question I have is, in your view, given the if you have a way to crystal ball, what would the completion of the VBIT look like in the future? What would be your aspiration for the end game of VBIT as what you have in terms of crystal balling the future?
Okay, so the aspiration of the industry is to be more purpose-led in what we do. It is also the hope of the industry that through VBIT we will be able to deliver the intended outcomes that we want to see, delivering something meaningful to the people, to the society, and also to our shareholders as well. And that is the ultimate aim of what we want to achieve through VBIT.
Thank you, Elmie. With that, we have actually come to the end of your session. And I just want to quickly sum up the key takeaway points that you have actually shared, which actually drive the rally and call to action. The first part is we hear clearly there is a lot of initiative that can be taken, and there are a lot of potential for collaborations, not just for this industry sector, but also collaboration with academics, NGOs, as well as those academics who actually have information, as well as the broader public sector, to pull together this information. You talked about how Mara and Tabu Haji are also the key players to actually come and collaborate and coordinate some of this collaboration. And you also mentioned about the essence to actually look at how the Maqasid Sharia and the Sharia intended outcome of principles can actually drive the sustainable prosperity for people, planet, and prosperity. So these are the various aspects that we can see in terms of potential. And I like the point that you mentioned that ultimately the idea is to drive a meaningful outcome. Hence, you raised a very critical point in defining or determining effective measurable KPIs that make sense and is essentially quantifiable. So with that, I thank you, Elmie, for your session. And we will then look forward to more conversations with you as well. Thank you, Elmie.
Thank you.
All right. Now we are now moving towards the last session, which we have with us today, Luisa Evaristo. Hi, Luisa. I see you. I would like to welcome our distinguished panelists here. We have Luisa Evaristo, and who is the Chief Risk Officer of Etiqa Insurance and Takaful, who is also joined by Ms. Norlia Yusof, who is also from Etiqa Insurance and Takaful. So just a quick introduction for Luisa, since you're there. So Luisa has a wide experience in the financial insurance and banking industries in actuarial and risk management capacity as the Chief Actuary and Risk Officer, right? Luisa also has strategic and management leadership in the complex Solvency II program across Europe and has experience in the development and implementation of enterprise risk management and capital management frameworks. So in the next 45 minutes, Luisa and Norlia would take us through on the discussions towards integrating sustainability issues into the investment decision making and what the key considerations and challenges are. So without further ado, over to you, Luisa and Norlia. Luisa, I think you're on mute. If I can just, you know, have you unmute.
Thank you, Arina, for the very kind presentation, and good afternoon, ladies and gentlemen. I think we are aware that today was a very long journey and a very enriching day, very insurance-linked issue, ESG afternoon. And we are here actually aiming at sharing our journey, along which we had the pleasure to collaborate and contribute to JC3, and where we are still building our foundations that target to enable us to integrate ESG risks into our investment practices. So moving to the next slide. So while I will cover the different parts where we are working and where we have been developing an understanding to integrate ESG risk into investment management, my colleague Norlia, she will dive later and share with you our own business case illustrating how we are planning to integrate ESG into the investment management strategy and processes. So maybe just giving a little bit of background and going to the next slide. I would like to enter into the risk management aspects, and in particular, in the next slide, please. Highlight that sustainability risk and ESG risks, they are actually terms that are used interchangeably and most of the times even misunderstood as going green or reducing the carbon footprint, or sometimes exactly the same types of risks, while as we have been hearing today, all journey, sustainability is much wider and is the umbrella of which ESG risks are a subset and are meant to be specific and measurable, and they are really the ones where we are going to focus throughout this discussion, especially because they are the ones where we want to make sure while we integrate the assessments, we are able to assess any material negative impact into the value of our insurance company assets that are backing our liabilities. Going to the next slide. And basically focusing really on the different risks, I would like to say that we within Etiqa Insurance and Takaful have been together and leveraging on the framework of Maybank Group, assessing and identifying how can we define and classify each of the components of this risk, and leveraging on all the learnings of the past. I would like to say that from our point of view, sustainability risks covers any other practices beyond ESG that could bring a negative contribution and reducing the resiliency of being sustainable. Governance risks concerns how the company is run, the management, the leadership, and the transparency of the decision-making that create and focus long-term value creation. While social risks, they actually concern the actions effects surrounding diversity, such as human rights, labor standards, consumer protection, health and safety. My focus is more on environmental risk. So activities that can bring threat or negative impact to climate change and the overall environmental ecosystem. How do we assess that? Actually, we need to then dive into climate risk, and in particular, the detailed risks that are arising from the different climate changes, such as changing on weather patterns that has long-term or widespread impact into both natural and human systems. This is a long-term impact risk, and to really be able to assess it, we need to then dive and look at physical risk as well as transition risk. While transition risks is the direct impact on assets, productivity, and trade disruption that arise from event-driven and long-term shift on climate-related events that we will feel over years and that we are already feeling today as a result of actions taken in the past. Transition risk is the disruption to the business as a result of the adjustment to low-carbon, greener economy. These two risk types, they really need to be understood and assessed in order for us to be able to then have proper analysis and proper decision-making in terms of what are the risks we want to maintain in our book and the risks we don't tolerate or we don't want to keep, but also they need to be assessed and analyzed in a way that takes into consideration the transition via different patterns and over time. I also have here obviously liability risk, which is very critical in insurance. However, I will not cover it given that our focus is on assets today. Moving to the next slide, please. Maybe trying to highlight with a particular example, how can we look at ESG risks and how can it impact the insurer's asset investment? We need to bear in mind and we need to keep always this reflection that sustainable investment is about long-term risk management, is about building resilience, is about having their system that will reward the insurer's long-term responsible investment and benefit to the environment and the society as a whole. If we look in particular to the three dimensions, environmental, social, and governance, we can immediately perceive that, for example, direct impacts that can come from climate risk that relate to increases of frequency and intensity of losses, which can have then a potential damage to our assets, may lead towards immediately volatility into prices and a lack of search for certain assets, and this will have immediately a direct impact into our book. However, this can also arise via litigations that may take place linking to the environmental risks that are in the root cause of the losses that have been created. There are other indirect impacts that will also change the price and the value, which relate simply to the customer shift of preference towards more environmental friendly and globally recognized products as well as assets. And over there, I think that the main message that is important also to leave here is if in terms of adopting an understanding of these impacts and these potential financial reflections into the books and the assets that we have underlying our liabilities, we don't move fast enough, then we may have their losses that we don't expect. And obviously, we cannot put aside then the analysis of all the social related risks and cover then all the items that have been already discussed before relating to labor practices, workplace safety, data security, product safety, diversity, legal action, damage to brand equity and reputation, as well as different paths that regulation can bring simply because there was not enough action taken. And these can be to a certain extent mitigated or even escalated if the governance is not strong enough and if it is not really looking after the best holistic interest of the long-term benefits to all stakeholders and to the economy in general, making sure that there is a promotion to accountability and long-term focus while providing transparency and a clear link between all these elements and enabling us to have a sustainable approach. Moving to the next slide, please. We can then focus specifically on integration into the investment risk management process. And in the next slide, we would then have to evaluate how do we integrate all the ESG risks, and in particular the E and S risks, across the chain of risk management when we have the credit risk, where we are exposed, the market risk, the liquidity risk, the operational risks, and the business risks. This needs to be assessed holistically, and we need to make sure that we incorporate the different elements, taking into consideration that our liabilities are long-dated liabilities, and that our products, they sometimes may reflect the return that the assets are going to generate. Other times it may result into a liability and a financial strain to the company. So maybe giving a little bit of light to how we can then incorporate and using concrete examples. If we focus on credit risk, and there obviously our concern is always the failure of counterparties, including sovereigns, to fully honor their obligations due to a climate risk impact. So we need to assess the credit elements in our investment book from the climate risk lens, meaning that we need to take into consideration the increase of probability of default due to a climate event. And obviously, if no action has been taken and the asset becomes a stranded asset, this is also a credit risk within our book. Moving towards market risk, and not really going in detail into all the elements, because one of the key areas that also mitigates the risk assessments is the advancement of technology. In particular, when we are looking at market risk and the risk of loss arising from adverse changes in prices and the value of assets and liabilities as a result of climate change. Our main concern is that climate change and climate risk, and here I refer in the slide in particular to flood risk, for example, this may lead to severe impacts on the pricing as a result of disorderly transition to a low carbon economy. So we don't need to have there just the flood risk. We may have other factors that due to its nature, due to the sector and the industry that we are exposed to, may lead then to a decrease of demand and an impact in terms of the market value, leading then to a loss that is due to environmental, social, legal, and even lack of technical response. And this has a direct impact in terms of the prices, and it should be tailored then to market risk. Liquidity risk, how do we reflect then? Well, our assets may become less liquid, and it can be due to an increase of credit risk, but it may be also just driven by market sentiment. Operational risk, which links to the destruction of operational sites and business disruption, is another area which is very critical and where climate risk is a key impact and where we should really embed the assessment. And then business risk, which is the impact on the company's capacity to generate sustainable profits, making sure that the investment strategies reliant on carbon intensive activities that are not profitable anymore, they have been taken out or they have been defined with a policy and with a strategy that is very clear. And then the assessment of all the lagging risks, making sure that we are able to then optimize the exposure and define clearly what are the assets we want to keep and the assets we want to acquire to put in our books. Moving to the next slide, please. How do we do this in terms of real risk management? Obviously, and once again, we need to start by making sure that we have a very good understanding of the high risk industries and sectors, and that we then establish new ESG, ERM risk assessments by industry sector and investing companies, looking at physical assets or investments that they are exposed to geographical factors, and then understanding really the underlying risks that come from transition and physical to the different assets that are in our book. As I mentioned before, it is easier said than done. We are in the journey of developing some of these elements. It is a journey that obviously simply has to be started and over time needs to be improved little by little. We can learn a lot from the portion of risk assessment and identification, and then move towards having there the measurement and the establishment of scenarios and stress tests that then need to be incorporated as part of our internal capital assessments, and which enable us then to make sure that we are establishing the right targets, limits, and we can move towards having a risk control practice, which is designed to enable a sustainable investment strategy that really meets the business objectives and that optimizes the return that our policyholders expect, but also our shareholders overall. And then obviously we need to evolve towards having the right monitoring, covering all the elements of the ESG scoring and factors per industry, and making sure that we are able to assess the financial impact that it can bring, and then be able to report it transparently, enabling there a decision-making process which is smooth and fully aligned with the analysis that we do already today in a traditional way, but now incorporating in particular the climate risk element across all the processes, across all the methodologies and the approaches that we already have in place. Towards having the right and the most adequate risk management processes in place, there are obviously various challenges that anyone that has started the journey could share. In the next slide, we did there to list a few. Lack of information and inconsistent data. It is always a threat and always one of the key challenges that we have whenever we start doing analysis where scenarios and quantification of financial impacts is part, and in particular on the ESG journey and looking after physical risk, transition to low carbon economy. having their data that is systematically compiled and in particular covering the right geographies and the right industries and integrated into our processes is really a challenge. Many times, even we have historical information, it is inconsistent and it does not cover all the elements we need. It is an evolving process. We need to start and we need to learn as we start collecting the data and analyzing this data and linking it with the analyses. As I mentioned before, it is a complex and at the same time a very rewarding process because we learn actually quite a bit throughout this journey. And having there the models which can estimate the ESG risk-adjusted probabilities and put in place the right forward-looking elements of the risk profile is obviously another very important challenge, given that in terms of the skills and in terms of the maturity of these processes, methodologies, and approaches, everything is very recent and everyone is still learning on how to do it. Quantification, it links quite a bit with also identification, and it is obviously critical, especially if we want to have there a proper assessment of the impact, linking with the different time horizons and science-based, enabling future strategic directions being validated according to the targets and strategies that the companies as a whole, they define. This implies obviously the creation of new quantifications and new models. And then obviously the final big other challenge is integrating all these ESG elements into the risk management framework and in the financial planning, making sure that the knowledge, the skills are embedded across the organization and they are adequate for the different levels that need to play a role on the decision making, on the assessment of the risks, on the reporting, and on the decision evaluation process, which should go beyond the regulatory compliance and which is critical to validate what is the risk appetite of the organization versus the risk profile, and making sure that everyone is involved and fully committed and accountable for the progress that is achieved year by year, even though, as Marcel has explained in the beginning, we are discussing many times impacts, quantifications, and changes that are going to happen in the profile within 30 years. So we always need to have an eye into the future as we are having all these discussion and these implementations in our risk management frameworks, approaches, processes, and practices. Moving to the next slide, I actually dared with the help of my team to try to give an indication of how could we put in place different investment approaches and where are the different organizations actually targeting to put their strategy and their focus on the ESG integration into investments. So moving to the next slide, actually, I believe that Spectrum Capital is a great way of showing how different investment approaches and their financial goals align to the impact they make on both people and the planet. So what we have here is, in one extreme, we have the finance-only approach, which we could also nominate as the traditional investment approach, which is investments targeted for risk-adjusted financial returns, having limited or no regard for either impact of environmental, social, or governance practices. Then what we have moving towards the right is the different variations of this strategy, but ones in keeping with the growing expectation that money must do good as well as generate return. So we have there the responsible investment approach, the sustainable impact investment approach. Responsible investments target to mitigate ESG risks and avoiding harm to the society. Here we can recognize the risk-based taxonomy that we have been developing and that we are trying to apply. And while we avoid harm to the society, we are generating returns. Better still, the sustainable investment approach that actively pursues at positive ESG outcomes for the society in addition. And these two, both strategies are still creating there an overriding concern because while they want to deliver returns, they are competing one against the other. And evolving more towards the right, we have there the philanthropic investors approach, which it's not really focused on returns, but really contributing to sustainable solutions. And it would be wrong to say that it is not doing the assessment on E, S, and G for any investment. No, it will be actually the more rigorous approach and assessment will be demanded by these investors because they really want to be fully convinced that there was an impact before they put in their investment. So they also will focus quite a lot on having their high measurable impact solution in place. And then what we have next is a pool where we would like to actually assess from the audience, what is your view? How would you select one of these approaches in which you see your company being within the next 5 years? Following a traditional investing approach, a responsible investing approach, a sustainable impact investing approach, thematic impact approach, or an impact first investing, or just the impacts, taking into consideration, obviously, the introduction made in the slide. And we'll give still some minutes to get the votes. And Arina, can we have the outcome?
Yes, it's actually coming up, Luisa. So we do see 44% clicked on sustainable impact investing, followed by 20% on responsible investing. And the two others, down the line is thematic impact investing, which is a 2%, and traditional investing 1%. For the impact first investing and impact only is at 0. So it's quite clear that there are direction on sustainable impact investing.
So I think, well, these are really great news, and it shows also the aspiration of all the people that is in this forum and in this webinar, because there is really an interest and a commitment, because I think the voting indicates a commitment towards sustainable impact investing, which clearly will optimize the return while taking risks. And it targets already 5 years from now. We have another pool, which is where do you see it within 15 years? Can we have another voting, please?
Sure, it's up.
Maybe we can get the results within a few more seconds. So Arina, can you tell us whether we would see a big shift? So the rate of sustainable investment has increased significantly, and we start having someone more even towards the philanthropic side of impact first and impact only. Well, the reason why we introduced the pool like this and was actually to give an indication that in terms of the approach, the sustainable investment approach, there is no right or wrong, but there is a journey. So it is important that it is started. And in the traditional investment or investing approach, we are already today. And year by year, step by step, we can evolve towards an approach that is much more reflective of the targets and the ambitions of every single investor and company. So with all this in this introduction, I would actually then pass the word to my colleague Norlia, and she will provide us with a more Etiqa-based indication of how we have been applying it so far, even though, as I mentioned, we are in a journey where we are learning and we are developing the different elements. We started it 1.5 years ago. Norlia, I pass to you.
Okay. Hello, everyone. Next slide, please. I would like to share the investment practices at Etiqa. Okay. How we integrate the ESG into our investment process. Next slide, please. Okay. What are the business cases for integrating ESG? I think you can see very clearly in this graph that ESG investment are expected to grow. Where we are currently today, the amount under asset under management is around close to 50 trillion US dollar. But by 2030, we expect it to pass 100 trillion US dollar. In fact, if we were to look closely to the tables, we can see that it is around 125 trillion that we expect the asset to grow by 2030. That is more than double from where we are now in terms of the asset that is under management for the ESG. Yeah. Next slide, please. Okay, this is interesting. What are the business cases for integrating ESG? There's a growing social interest in sustainability and value-based investment. So this surveys was done by Schroders Global Investor Study in 2020, and it is an online survey to 23,000 people who invest from 32 locations globally. So the outcome of that, you can see that are sustainable investment attractive? So there are 47% say yes because of the wider environmental impact, and 42% say yes because they are more likely to offer higher returns, and 32% say yes because of my social principles. So very interesting. And 11% say no because they won't offer higher return, and 4% say no because they are not aligned to my principles. Okay, so these are based on the survey results, but whatever it is, 47%, which is a high percentage, thinks that yes, because of the wider environmental impact. Okay, what about the generations? If we look at by generations, millennials, 18 to 37 years old, 75% thinks that no, I would not invest against my personal belief, but 25% say yes if the returns were higher. So this is quite expected because we know millennials are often thought of as having a more sustainable mindset and being the most proactive generation in this space. It can be seen that the millennials have an awareness of ESG and will invest on their belief in ESG. So the potential is there, yeah, because the millennials seems to gain traction on the ESG belief. Next slide, please. Okay, this is on the asset size. What you see on the x-axis is the number of funds, ESG investment funds. So it has been steadily increased from year 2004 to year 2019. The light blue is equity number of ESG funds, and the darker blue is the number of fixed income ESG funds. So you can see that the steady growth on both assets does indicate that there are a lot of demand for ESG investment. The consumer preference and regulations drive growth in ESG investment. So this is also from the Moody's Investor Service that we have gathered the infos. Yeah. Next slide, please. Okay, this is based on Etiqa, our own pseudo portfolio, where when we did the calculation from year 2014 to 2020, out of these 7 years, we discovered 5 years where the ESG portfolio outperformed FBM KLCI. So the pseudo portfolio that we have done is based on the Refinitiv ESG data and the selection of Malaysian stocks under Refinitiv coverage that meets Etiqa indicative ESG threshold. So we use our in-house model to filter, we extract the data, and we calculate the ESG score and the performance, potentially delivering positive returns via responsible investing. Okay, next slide, please. Okay, this is when we do our Etiqa ESG emerging market pseudo portfolio versus the MSCI emerging market index. You can see from 2015 is also producing a performance that the results which is outperformed the MSCI emerging market index. Again, we use Refinitiv ESG data and we do the selection on emerging market stocks under Refinitiv coverage that meets our requirement. And using our in-house model, we filter it and we calculate the ESG scores and the performance. So it has been consistent, Malaysian stock as well as emerging market, both actually outperform the index. Okay, next slide, please. Next slide, please. Okay, so what are the action steps towards integrating the ESG into our financial analysis? The step 1 is to assess the quality ESG data via the ESG data providers. And can I have the next slide? Okay, this is the action steps to integrate into the financial analysis and the accessibility to quality ESG data. What are the process? The selection process of our ESG data provider. So these are some of the criteria that we look at when we select our ESG data provider. The data that are provided, the number of companies within their coverage, the research capabilities, handling of greenwashing, and how frequently they update the data, and the location covered by the provider. Okay, next slide, please. Okay, these are when we identify the ESG scoring methodology for the environmental, social, and governance, what you see in the boxes down there, there are 10 boxes down there, are all the factors that we take into consideration, like low carbon economy, climate change, when we do the scoring methodology. Okay, next slide, please. Okay, this is our in-house model. So we develop an in-house model which combines the ESG data and the ESG scoring methodology to obtain the ESG for Etiqa ESG score. So this calculation we have done, and we do assign weightage to the E, the S, and the G. So using the Etiqa own scoring, we come out with the model that actually will come out to the Etiqa ESG scoring. Okay, next slide, please. Okay, so collaboration, which is our step 4, collaboration with ESG partners and to be aligned with regulatory policies like Bank Negara and Principle for Responsible Investment. So we evaluate the benefits of having the collaboration for branding and marketing position. We also align the policies with regulatory bodies, and we also align with our Maybank Group position on collaborations. Okay. Next slide, please. I think this is my last slide. Yeah. Thank you very much. That's all.
Thank you, Norlia, and thank you, Luisa, for this good sharing. And I think it's very, very informative in terms of what Etiqa is doing. And I think the fact that you share how the impact, the investing mechanisms, the tools, and the strategies that has been done would actually help benefit the participants today as well, to what level of advancement they can actually look towards. Now, maybe if I may, I would like to quickly get into the Q&A session. So looking at the areas that you have actually both shared, Luisa and Norlia, when it comes to impact investing, what are the biggest challenges in terms of driving, given the different categories, what are the biggest challenge that you're tackling in the more immediate term right now? Given that Etiqa has already advanced to a certain level on some of the ways and strategies of investing, what are your current pain points that you wish to also share for those who are on this journey? Luisa?
So yes, what are our pain points? Well, we started our journey, so we are developing the framework and getting it implemented. We are creating the tools and the support to enable risk assessments, due diligence in certain elements and exposures that we have. We are not yet there, right? So the challenges, they relate with what I also spoke before about, having there the capabilities, having there the tools, integrating different data elements as well as methodologies into our processes. And yes, Norlia has been showing the model that is being developed for ESG scoring on assets. It is not yet completely ready. It is still in development, and as explained, there are 3 phases ongoing. So having there the skills, the talent, the advisory, the understanding, applying and doing analyses, and making sure that it links with them defining limits, strategies, and taking actions are some of the challenges that we have. But I would say immediate is making sure that we all understand even what we are speaking about.
Thank you, Luisa. And Norlia, would you like, can I invite you to also add on that? Because I see a lot of effort you've put in, and I can feel the,
Yeah, I think the most difficult part is actually to build the scoring methodology. As we look at a few providers, Sustainability, Refinitiv, MSCI. So it applies different methodology and different weightage, so we need to come up with something which we think will apply across the board, and it actually also throughout the whole Maybank Group. Yeah, so we have to also be mindful that within the group we also have the sell side and the buy side. But when it comes to scoring, we need to come out with a score which reflects fairly to all the entities within the group. So what we have done is we study a little bit more detail on the methodology of what's being done by the provider, and we try to come up with our own methodology. I think that's the I must say is our pain point actually. Yeah.
But I think you've shared, Norlia, very good statistics, especially when comparing to the MSCI, and that is very helpful because to a certain extent it is quite a global reference that actually can reinforce that you're essentially all these have a certain level of indicative that actually can be rationalized to actually bring forward this advancement. Now, I would also like to give a good recognition for Maybank. Your group has announced your commitment to a carbon neutral position of emission by 2030, and to also achieve net zero carbon emissions by 2050. And I can't leave that out because essentially that drives your strategy direction in that aspect. So how do you see this commitment actually help you to rally a more definite and direction in terms of your action?
I think for us, we are actually committed to have full compliance on ESG for our equity portfolio by 2025. That's our aim and our target.
And Luisa, your thoughts on that?
Well, it is a commitment where I believe Etiqa Insurance and Takaful will be contributing to the group, aligned with our risk profile. So insurance, as it has been organized today, is different from banking. So obviously we will contribute in a different manner, but we are all committed as part of Maybank Group.
And maybe I will also get your thoughts, in your stakeholder engagement, especially, on the investment side of activities and stakeholder engagement. What have been what would be your advice for those who are also, having the same conversations with the investees companies? How do you then look towards, driving coordinated discussions? Because what we'll see is all the investors will be asking the same information, same responses from their investees. So how do you then, what would be your tips based on, the journey that Etiqa has already moved on?
We need to engage more and be transparent with the companies that we invest, the investees company, on our investment metrics, which is evolving based on the ESG factor in the modeling to our investment. So further deliberation is to allow companies to know what is being considered and to encourage further disclose of data pertaining to ESG. So if the investing companies are clear on all those requirements, I think they will, to a certain extent, work towards it, improving on their ESG. Yeah.
And Luisa, your thoughts as well?
Well, as you have been seeing today, I think that the most important action that needs to be taken is to remain humble and share and benefit from development that the different players in the market are making. But really trying to build a common understanding and the sharing. So being part of the JC3 group, being part of Maybank and liaising with different other counterparties, actually by sharing our experience, the different models and methodologies, it actually helps everyone to make progress and to have better engagement then with investors or even with analysts. And also investors and analysts, they are willing actually to share as they demand data and certain assurance from us.
Thank you very much. I think, your presentation, both Luisa and Norlia, has been so comprehensive that I think it does really outline the puzzles, the jigsaws, the step-by-step, that the sector would benefit. And, I think we are looking to see more further collaboration to actually strengthen not just, the ecosystem, but also the broader economy of Malaysia in this sense. So with that, I do thank you, Luisa and Norlia, for your very insightful sharing. And we look forward to taking these conversations further as well as we move ahead. Now, with that, I would like to now pass the floor to Marcel to help us to wrap up the sessions today. I know we've come to the hour, and we had a very productive discussions on insurance and Takaful. There are feedback questions, 3 feedback questions, and we hope that you have found today's sessions informative. Please, we seek your kind feedback, to let us know and feedback to JC3 on the impact of today's session. So maybe I'll pass on to Marcel for you to help us to close today's session.
Yes, happy to do so. Yeah. First of all, a big thank you to all the presenters. I think it was fantastic presentations. All 4 presentations gave a lot of insight, and naturally also to you, Arina, for being a great moderator. Rather than summarizing now all 4 presentations, let me share with you 5 key themes I have picked up from all the various presentations. First of all, ESG is critical for insurance and Takaful, and the goal is to achieve a meaningful and sustainable growth. Secondly, a call for action was made to take ESG, sustainability, into consideration in risk management, underwriting, investment, and operations, and no action is not an option anymore. Progress over perfection, and we have to keep in mind that it is a long-term game. Thirdly, sustainability is not only a threat, but it's also a growth driver. And in various presentations, some sustainability solutions were presented also for Malaysia. Just want to mention a few, such as flood resistance cover, sustainable mobility solutions, protection for low-income population, and or solutions for the transition to renewable energy. The 4th key theme is that there is a growing importance of ESG investments, also from a profitability perspective. And 5th, but last but not least, insurance and Takaful industry cannot do it on their own, but they need to engage with other stakeholders, such as the government, regulators, other financial institutions, and the public at large. With this, from my side, these are the key themes. I think with this, I would like to wrap up the afternoon. Thanks again for attending, and please stay safe and healthy. Assalamu alaikum.
Thank you very much, Marcel. And I would also like to thank the stellar line of speakers who have, imparted the valuable sharing sessions and, have actually also come up with a call and rally to action within their discussions. So I want to thank, last but not least, all of you participants who have actually stayed with us to the end, and your active participation throughout the day, the questions that you have actually shared with us to the panelists. Now, please join us tomorrow for the further discussion on sustainable finance and the management of climate change. We will be discussing Bank Negara's green taxonomy tomorrow, giving tips to how to operationalize the TCFD, providing insights on climate risk disclosures, and more. We will also be hearing from the Ministry of Environment and Water on the national agenda on sustainability, and from the Minister of Finance on sustainability in public finance. I hope to see you tomorrow. The JC3 Finance for Change Flagship Conference is co-hosted by Bank Negara Malaysia and Securities Commission. This event is supported by the UK government's Low Carbon Energy Prosperity Programme in partnership with Ernst & Young. This conference would not be possible without the support and hard work from CIMB, SME Bank, and Zurich, and without the help from our knowledge partners, Climate Governance Malaysia, WWF, FIDE Forum, SwissRe, Fair Finance Asia, AFI, IPFIM, and our stellar line of speakers as well. We wish you all a good evening ahead. And as Marcel has mentioned, stay safe and we'll keep in touch. Thank you.